New York City, I'm Brad Smith alongside Madison Mills this morning. This is Yahoo Finance's flagship show, The Morning Brief.
The S&P 500 and the Nasdaq set to open at record highs, led by gains in Nvidia, of course. But we're also watching European markets following two interest rate decisions. So let's get to it with the three things that you need to know this Thursday morning as you prep for the trading day. Yahoo Finance's Inez Ferre, Jennifer Schomburger, and Jared Blickery have more. The S&P 500 and Nasdaq futures climbing higher this morning, on track for a winning week, buoyed once again by Nvidia. The chip giant surpassing Microsoft as the most valuable public company in the world. The stock is up more than 170% this year alone. The hype around AI has helped the rally in equities. And the S&P 500 and Nasdaq Composite hit fresh records Tuesday before the markets closed for the Juneteenth holiday. The two indices are set to open at fresh record highs this morning.
And it's a mixed picture for interest rates this morning. The Bank of England is holding rates steady at a 16-year high. The bank choosing to stay put despite earlier this week showing inflation in the UK fell to its 2% target for the first time in 3 years. It also comes 2 weeks before the UK general election. The pound falling against the dollar this morning. Meanwhile, the Bank of Switzerland is making its second interest rate cut of the year, citing a drop in underlying inflationary pressure. The Swiss bank trimming its key interest rate by 25 basis points. The Swiss franc rising today against the dollar. Here in the U.S., more than half of traders are pricing in the first interest rate cut in September.
And we have fresh jobs and housing data out this morning. On the jobs front, 238,000 people filed new claims for unemployment benefits for the week ending June 15th. And that's a few thousand higher than analysts expected. But it's a decline from previous weeks, and those weeks were at revised levels. Now, the labor market has showed signs of some cooling, but overall remains strong. And on the housing front, both starts, which means new construction, and building permits, they came in below expectations, a sign that higher mortgage rates, they continue to weigh on the market. Both data points also coming in below the prior month's levels.
Well, good morning, everyone. Nvidia officially becoming the most valuable public company on Tuesday. The chipmaker's market cap surpassing Microsoft and now worth $3.34 trillion. This comes just a few weeks after the company crossed that $3 trillion threshold for the first time here. Shares of Nvidia, they're up over 170% so far this year. There you're taking a look at that continued rise that really kicked off in 2023 and continues to move higher in 2024, pushing it to its newest accolade that it can tout for itself right now.
Yeah, it's interesting. It's just the 12th company to hit a record high in the S&P over nearly 100 years, so joining a very elite few there. But I do want to talk about the negative elephant in the room that we've got with Nvidia, because the 10 top largest stocks have been up 17% in the past 3 months. The rest have actually lost 1.3%. So it's a question that we're having about concentration. Another big issue at play is whether or not the growth that we're seeing with Nvidia is going to be able to continue. March 2000 was the last time that a computing infrastructure company was the most valuable company in the S&P, and that company was Cisco, clearly not near the top today. So it leads to this broader question about whether or not this is another tech bubble moment and whether Nvidia can continue to keep up the pace of growth that the street is looking for.
And we should note, most valuable U.S. company
Yes.
here. Of course, you got to continue to remind ourselves that Saudi Aramco is out there somewhere just sipping
True.
coffee and chilling on its laurels of sorts. But anyway, one of the huge things as we're thinking about this market stat for Nvidia, also think about the market share that it comes with as well here, especially within some of the chip segment. The graphics card shipments are up, according to John Petty Research, and the stats that they were able to put out for Q1 of 2024, up by about 39% year over year. And you think about the market share for that, for Nvidia, 88% in Q1, according to JPR, and that's compared to 80% the prior quarter here. You're thinking about some of the other players out there. You're right to think about that. AMD, that fell from 19% to 12%. Intel also struggling to keep up with some of that demand, and the market share battle and jousting continues to move forward. The last thing that I'll mention on this too is it's interesting where the street is continuing to rally right now. And this is not a specific Nvidia story, but it is a generative AI story where you're seeing, according to FactSet Research, some of the most bullishness and buy signals right now. Of the three top buy signal or buy rated companies, I believe it's Microsoft, Amazon. Amazon should be that top one. You've also got Microsoft, and then lastly, you've got Delta Airlines, of course, of the airline fame. Anyway, of those companies, Delta Airlines, Amazon, Microsoft, all seeing the strongest buy ratings in the market according to data from FactSet. Two of those three companies, of course, strong generative AI plays for the market.
Right, and really interesting, though, to see that the fundamentals still matter, and that's why you've got Delta in that mix as well, Brad.
100%. We've also got some fresh economic data out this morning. Jobless claims falling to 238,000 last week. That's down from the 243,000 the prior week, but still sitting near a 10-month high. We've also got some housing data with housing starts and permits falling more than expected during the month of May. So two economic readings for the market to really digest going into the start of today's trading activity, perhaps a little bit more of that weighting given to what we're seeing in the employment situation front right now.
Yeah, and it's interesting because this is kind of like the B team of data, but it can be a leading indicator still because of what it tells us about the status of inflation. When you look at these starts and permits, they are the lowest since 2020. So that is a key metric to be watching here, particularly when you think about how this could drive the inflation narrative. I'm excited to talk with our guests later in the show about this because if there is this dearth of supply that has typically supported housing prices, could that be inflationary moving forward in the housing market? Or is it really just about when the Fed is going to cut back on rates and what that does to demand and, of course, the price impact that groundswell of demand that has just been waiting for cuts could have on the housing market moving forward? But it was interesting to see that surprise in starts and permits. Again, the lowest level since 2020 was not necessarily anticipated coming into the day.
Yeah, and just as we're thinking about what this means more broadly here, especially as we're kind of, and I'll zero in more so on the housing data front because it's particularly interesting. You've also got some fresh data out from Redfin this morning, which had really pointed at three main things within this broader housing market right now. Buyers backing off largely because housing costs are high. The irony of near record high housing costs causing buyers to back off, and enough of them have backed off to give buyers who remain more negotiating power for certain homes. And then lastly here, new listings still near historic lows here. So those really three of the factors that are really weighing into this housing situation as of right now.
And potentially the idea that the Fed, is going to have reason to cut rates because we're seeing a little bit of pressure in consumer spending on all things, including housing. Okay. Well, traders remain mixed on the Fed's path forward, as we're talking about here, with nearly 60% still anticipating a rate cut in September. Our very own Jennifer Schomburger spoke with Boston Fed President Susan Collins in an exclusive interview on Tuesday. Susan Collins stressing the importance of not overreacting amid volatile data.
I think what we've seen in the data, and again, consistent with what I heard on the ground today, is things are very volatile. You get some welcome news and then they're challenging news. And so I think it's really important not to overreact to what has been encouraging. I think the data that we have seen recently in terms of CPI, in terms of the producer prices, is consistent with an economy that in an orderly way is becoming better aligned.
For more on this, we are joined by Jake Manoogian, JP Morgan's U.S. Head of Investment Strategy. Jake, thank you so much for joining us in studio. We really appreciate it. And for joining the Billie Eilish listening party earlier, too. But I want to join the Neil Kashkari listening party with you for a second. He was speaking this morning, a little bit less fun, perhaps, not for us. But he said that it could take a year or two to get down to 2% inflation. Do you agree?
It could, but I think that argument is a little bit less relevant for investors. I think the fact of the matter is the global rate cutting cycle is already well underway. We track 37 central banks, 20 of them are already cutting rates. The Fed's going to join the party probably at some point this year. We're 90 days away from the September Fed meeting. Traders are pricing in a 67% chance that that's the first cut. And I think that's what investors need to focus on.
What if we don't see the first cut at that point?
Well, then we'll kick the can to December, but it doesn't change the global backdrop that central banks are in easing mode. And Kashkari's been on the kind of hawkish end of the spectrum. It seems like the core of the committee, and Jerome Powell especially, is very much aligned on this idea that they don't need to get to that 2% target to start cutting. Maybe they want to be there on a 3-month annualized run rate, But I don't think they need core PCE to be at 2% to start cutting rates.
It's interesting, though, when you talk about the global rate cutting cycle, you have the Swiss National Bank kind of kicking off that domino effect, right? Mm-hmm. One cut then followed by another. We're not seeing that same path forward for every central bank, though. Not all rate cutting cycles are going to be equal, right?
And I think that's a big difference between the rate hiking cycle that we saw, which was very coordinated and very aligned.
Sure.
Whereas this easing cycle is going to be a little bit more staggered. To us, that means there's probably a little bit more volatility in currency markets, maybe a little bit more volatility in FX and kind of cross-currency fixed income. But as long as central banks broadly are pointing in the same direction, it seems like the direction of travel is clear in terms of the support that gives for risk assets.
I mean, the Bank of Canada would also mention, how dare we forget about the cuts that they put out there
really good point.
ahead of the others. But anyway, one of the huge things that we're trying to figure out from an investment strategy perspective, if you're an investor waking up this morning, this holiday abbreviated trading week, perhaps there's low volume that you're going to see, but you're still trying to chart your next portfolio positioning if we do head towards a wave of cuts. What is the biggest thing that you should be thinking about?
I think the first thing to think about is to be very skeptical of cash. I mean, what we're seeing on our platform is our clients have around 30% of their portfolios in cash. That's up from an average of 25%, when interest rates are at zero. There's still a tremendous amount of cash that's on the sidelines that's been enjoying these kind of 5% plus treasury bill rates that are in real terms, 2.5% after you adjust for inflation. So that's the best that picture's looked in a very long time. We've been in a zero and negative real interest rate policy for a while. So cash hasn't been trash. It's obviously underperformed the S&P 500, but I think it's felt like a safety blanket. And that safety blanket is going to get much less attractive when rate cuts start to come. And when you add a layer of the idea that the Federal Reserve is going to be cutting rates most likely outside of a recession, the underperformance to both stocks and bonds is pretty meaningful when we look back at other soft landings. So that's the key view for us for if you're waking up this morning.
Sticking with the bonds portion of that, I am curious whether or not we're starting to see kind of a peak in bonds, given that we've got 90 days until that next potential cut from the Federal Reserve. If that is to be true, have investors missed the opportunity to dive into treasuries, particularly at the front end of the curve?
I mean, they probably missed the peak in yields, right? I think, the 10-year in our view, in our base case, probably isn't going back to 5%. But that doesn't mean there's not opportunities in fixed income, especially for U.S. taxpayers. I mean, municipal bond yields have underperformed Treasury yields over the last month, and they've finally widened out to levels that are a little bit more attractive on an after-tax basis. That's one of the key areas where we're focused, that is even more important if you're in a high-tax state like the tri-state area, California, et cetera. And then when you think forward to the election, which might be a topic of conversation later, people are worried about the deficit. They're worried about the national debt. We're less focused on what's actually going to happen in this election and more focused on the long-term direction of travel, which is likely to higher tax rates for individuals. So that makes tax efficiency in your portfolio all the more important, and municipal bonds are kind of the anchor for that allocation.
And also, since you mentioned it, in a year of global elections where more than half the world's population expected to participate in one form or another, this could also have a major impact in terms of foreign policy and the international business relations, where that is actually could potentially be a tax on top of what we're already accustomed to here. How do you see that changing in this kind of broader, the broader outlook that you were mentioning a moment ago?
I mean, to us, that's beside, you guys were spending the beginning talking about AI and the mega trend that we see there. The second mega trend that we see is around industrial policy. And this is another similarity between both candidates, both parties, and around the world, is that there's a renewed focus on resiliency. After the pandemic, given that global conflict is at 80-year highs, companies and governments are laser focused on making sure they're secure. And security goes beyond traditional defense. It relates to supply chains, infrastructure, cybersecurity, natural resources. And that, I think, outside of the noise around the election, investors can focus on that and the companies and industries that might benefit.
Jake Manukian, who is the JP Morgan U.S. Head of Investment Strategy. Jake, great to see you here in studio with us.
Thank you.
Thanks.
It's great to be here.
Well, the Swiss National Bank, as we were just discussing, Norway's central bank, and the Bank of England, all announcing different decisions on their respective countries' interest rates today. Switzerland cutting for the second time this year. Norway remaining unchanged, along with England, which will hold steady heading into their parliamentary elections on July 4th. Wow. Our own Jennifer Schonberger has more. Jennifer, take it away.
Good morning, Brad. That's right. 3 central banks taking action this morning. The Bank of England opting to hold rates steady near a 16-year high, but signaled it could follow its European peers in lowering rates in the coming months. The UK central bank held its key interest rate at 5.25% for the 7th straight meeting, in line with what investors and economists had expected. Much of the decline in UK inflation over recent months has been owed to falling energy and food prices. The Bank of England worries that since those declines are unlikely to continue, rapidly rising prices for services will push the rate of inflation back above its target in the second half of this year. Meanwhile, the Swiss National Bank cut interest rates for the 2nd straight meeting, pointing to easing price pressures. Switzerland was the first to begin cutting rates. Elsewhere, Norway's central bank also stayed on the sidelines today, leaving its key rate unchanged. Now, these moves coming after the European Central Bank cut rates for the first time in this global rate hiking cycle earlier this month. As some global central banks opt to cut rates, here in the U.S. Federal Reserve is continuing to hold rates steady. Boston Fed President Susan Collins told me in an exclusive interview this week that she sees scenarios later this year for 1 to 2 interest rate cuts, though that will depend on how the inflation data come in. For now, the Fed is closely watching that inflation data. Take a listen.
I do think that it'll be important to see more information that is consistent. I think we have learned that there's no crystal ball, that there's no preset path. We have to let the data tell us, and it's not 1 or 2 indicators. It's looking more holistically at the information.
The next key piece of inflation data due out is the Core Personal Consumption Expenditures Index. That will be on June 28th. I will have more from my exclusive interview with Susan Collins on Friday. Guys?
All right, Jennifer Schonberger, Yahoo Finance's own. Thanks so much, Jennifer. Appreciate it. Well, everyone, we're just getting started here on the Morning Brief. Coming up, Dell getting a boost after announcing its plan to partner with Nvidia to build out an AI factory for Musk's XAI. We'll have some top trending tickers next. Plus, RBC Capital slashing its price target on Tesla. We'll speak with the analyst behind the call later on this hour. We've got all this and much, much more. And oh yeah, the opening bell in under 15 minutes. It's coming up on Yahoo Finance. Shares of Trump Media falling this morning after saying the SEC has declared the registration of additional shares effective. The move could dilute shares that are existing in the market already here. And there you're taking a look at the reaction here. Pre-market, shares are down by about 11%. What's interesting is they're expecting to potentially see an aggregate of approximately $247 million in proceeds. Now, they're likely to make sure that they can exercise any future transactions that would also include acquisitions or mergers, all of these things considered. It's cash that they would potentially want to put towards building out this media vision that they've communicated to the street, but not fully delivered to this point.
Yeah, and Brad, just to add a little bit of context there, this essentially allows investors in the firm's derivatives to swap out those derivatives, which are known as warrants, for holdings of shares in the actual company. But that can dilute those long-time investors in this name, which is not that long because it went public very recently. But over the past month, this is a name that's down over 35%. If I take a look at all time, though, the stock is still up, and it's up 80% year to date here. So a long-term investor story of growth, but this could be a bearish signal for those longtime executives, and that's exactly what we were seeing just after this announcement. That stock was down over 17%. So the question about whether or not this is going to dilute shares for existing shareholders moving forward kind of being affirmed based on that stock price, which continues to go down days after this initial decision, Brad.
Yeah, lost money during the first quarter, and it has been very memey of a trade thus far.
Very much so, very much so. Well, definitely not a very memey trade. We're moving on to Dell. The company shares moving higher after the company's CEO announced on X that it will partner with Nvidia to build an AI factory for Musk's XAI. Supermicro shares also getting a boost after Elon Musk responded that it will also be providing servers. And it's really interesting to see this move from Dell, Brad, becoming kind of the latest company to find a way to hop on to the Nvidia rally here. It does bring this question to mind for me, this idea that if you have all of these various companies kind of finding a way to invest in AI, additional AI capex, at what point does that dilute the overall picture? Then you're going to have so much competition in kind of finding any way to not only add investment in AI, but also specifically to partner with Nvidia. At what point do we stop seeing that be a bullish signal for stocks when they drop the Nvidia name?
Yeah, absolutely. I mean, I think for Dell, what they're trying to also make sure is that investors see the AI play for their company coming more to fruition, especially with some of the major partnerships like this. Nvidia, just another feather in their cap. But for Dell, for Supermicro, I think that this gives them a little bit more of fanfare that they could potentially kind of add on to what they've already been telling or trying to sell the street on with their own AI ambitions and making that just a little bit more real. In terms of Grok, I mean, they've been trying to make this work for X for, it seems like, the better part of almost a year now. I mean, you think back to the acquisition that eventually went through where Elon Musk was able to acquire formerly Twitter, now X, and make that his platform as he was trying to make an entire super app of many of his businesses here. X was intended to be kind of the first play of all of that, but Grok is actually within the platform right now. I don't know how many people use it. It's not a publicly traded company anymore, so they're not required to tell us how many people who are paying for subscriptions or are signed up or actively using Grok. So we don't get those updates, but it sits there on the side panel for me, at least. I haven't even tried to click it yet.
But you're exactly right on the timing. This is last November that the startup launched Grok and raised $6 billion in VC money to support that effort, but there's a question about whether or not it has been utilized by consumers like us. Shares of Accenture also moving higher after reporting $900 million in bookings from generative AI during the third quarter. Stock, however, is still down over 18% so far this year. And I want to take a look at what we are seeing in terms of the overall moves for Accenture, because this is yet another name that we've been talking about, Brad, that continues to try and find ways to incorporate the AI trade. Again, this name down 18% year to date, 10% over the past year. The question whether or not Accenture's kind of Gen AI addition here is going to be enough to add on some much needed support for this stock.
Yeah, not exactly a company that everybody talks about at the breakfast, lunch, or dinner table on a daily basis, but it is important given the fact that it is the highest market cap company that's going to be reporting earnings over the course of this week. Now, you mentioned the key thing in what they were talking about with their own generative AI bookings that they did see. Revenues all in. That ultimately, though, was a decrease of about 1%, an increase in 1.4% in local currency compared to the third quarter of fiscal 2023. All of these things said, they're saying that they're scaling in their business with another 35 acquisitions, $5.2 billion of capital deployed year to date. So a ton of efforts that's going forward within Accenture in order to really generate even more. And that $2 billion in generative AI sales year to date, $500 million in revenue year to date, which demonstrates what they say, an early lead in the critical technology. Interpret that as you want, but they're calling it an early lead, at least as of right now.
I mean, you can call it an early lead if you want, but the street is going to decide whether or not you are, right?
They will.
Speaking of, coming up, we've got the opening bell on Wall Street. We're going to see where stocks are moving here. You're looking at a bit of a mixed picture. The Dow under a little bit of pressure here, but the S&P up 0.2%, the Nasdaq pushing 0.3% to the upside. We're going to help you parse through the biggest movers of the morning after the break.
Bing bong, there it is. All right, the opening bell here on this Friday's Eve. You're taking a live look at the NYSE and at the Nasdaq, where I believe you've got The Executive Leadership Council ringing the opening bell. And you've also got the NYSE live shot there. Ticker symbol AOS. 150 years of innovation, I guess, is what the company is celebrating here. I was around for a sliver of it, but ultimately as a spectator from the outside looking in. So that's where we find ourselves as well today, looking at this opening bell. Let's take a look, though, at the major averages as we begin this trading session. Dow Jones Industrial Average begins the day flat, just barely to the downside. Nasdaq Composite, you're seeing that open higher by about 1/4% right now, 0.3%. In the S&P 500, you're seeing that open to the upside as well by about 0.2%. Let's take a look at some sector activity. Why don't we, Maddie? 11 S&P 500 sectors. We've got them loaded up here for you on the screen. XLRE, real estate, pulling up the caboose, but you've got technology leading the pack right now.
I mean, no surprise, right? This is the story that we've been talking about for so many years here. Oh, look, I pulled up the tech sector.
You
here.
did. Let's populate that chart.
Well,
Bingo.
It's fascinating. Look at that, 20% gains year to date. And then when you take a look at the more kind of broad market action, we're seeing something like the Russell pretty much flat year to date. But then you've got tech bringing up the S&P, bringing up the Nasdaq. So it's interesting seeing that level of concentration. My big question, though, when is that concentration going to start to potentially be a little bit of a problem here? Look at the Russell, just really round the flat line year to date here. We're going to get more of this fantastic intel from Yahoo Finance's Jared Blickery. He's looking at the market action for us. Jared, what do you got?
Yes, Maddie, thank you. Yes, the small caps, they've been doing nothing all year. So let's take a look at the S&P 500. Here's a year-to-date chart. But as we head into the month of July, I just want to share some statistics that were generated by bull boss Ryan Dietrich over at Carson Group. Can this rally continue? Be aware that July has been up 9 years in a row for the S&P 500. Over the past decade, higher 90% of the time, tied with November for the best, and up 3.1% on average, second only to November. We got a little chart here, and here's where we are. I guess the point to take away there, second best month of the year, July, over the last 10 years, that is a tailwind. And it looks like we got tech heading for an 8th straight day of wins right now, and that's just barely holding on to some gains right now. You can see it just flip negative, so it might give that up. But I have been tracking some other markets here. I do want to get into the futures market where silver has been advancing. It's up 2%. And here's the year-to-date chart. And you can see it was screaming higher earlier in the year, pulled back a bit. And you can see within the 5-year trend that it has just recently broken to the upside. So we'll have to see if we can get any momentum off of that. And then real quick, I want to check on Bitcoin as well. Let's put a 2-day actually on here so we can see what happened over the holiday. Not a whole lot, but we do have Bitcoin up to 65,000. It's been holding 65,000 recently. Here is a 3-month chart and more sideways action there. It kind of reminds me of the small caps. Guys?
All right, Jared, thank you so much for joining us. Really appreciate that. Now, after 8 days of wins for the tech sector, one tech name that is under pressure this morning is Tesla. That stock is moving to the downside here after down a little over 1.25% after our next guest lowered his price target on the name based on some new calculations for the company's robo-taxi program. Joining us now to discuss, we have Tom Narayan. He's RBC Capital Markets lead equity analyst for Global Autos. Tom, thanks so much for being here with us to discuss your decision here. Talk to me about the single biggest driver of this price target change for you when it comes to Tesla.
Yeah, there are really two things. The first thing is we looked at what pricing would be in a world of robo-taxis, and we realized with working with our internet team who covers the ride-hailing companies, Uber and Lyft, et cetera, that pricing will actually be lower. It'll come down as this will be a regulated industry. So we lowered our pricing. The second thing is we increased the value that we think will go to those companies, the app companies, the Ubers, the Lyfts, as a higher revenue share percentage than what I was assuming previously. So it's really those two things that lowered the Tesla-specific robotaxi valuation. But we still love robotaxis, and we still think it's going to be the biggest contributor for value for Tesla.
By when, Tom?
Well, my valuation, I think you guys remember, is based off 2040, and then I discounted back. But I do think on August 8th, we will get an announcement that we will start seeing some actually near-term deployments of robotaxis, but it'll be in cities like we've seen probably like from GM Cruise and Waymo and cities like San Francisco, Austin, Phoenix. It's a very small scale. You're not going to get this at mass scale for years, if not decades out.
And on that exact point, Tom, when do you anticipate the Tesla robo-taxi revenue kind of being a contributing factor to Tesla's overall profit margins?
Oof, not for a while. It could be 5, 10 years away, but it's one of these things where when it happens, it will happen in a big way, right? The automotive or transportation industry is a $6 trillion industry today. Autonomy, robotaxis, autonomous vehicles has the chance to make this much bigger, 10 billion potentially, right? Takes share from planes and trains and gives mobility to the elderly, children, people with disabilities. And so it's one of these things that will be a tectonic shift in how we all live. It's going to take a long while before it contributes financially to any of these companies.
Tom, when you think about city infrastructure, does there need to be a significant change in city infrastructure in order to facilitate safe robotaxi rollouts?
Absolutely. Yes. That's probably the biggest hurdle. We spoke to the CEO of Stellantis last year at our conference, and he said, like, the tech isn't really that far away. It's not the tech. It's really the cities need to re-engineer themselves, right? I mean, just think about, I don't know if you've been to Paris, the Champs-Élysées. It's not a lot of computers able to make decisions. It's humans making aggressive decisions on how to drive. And so cities have to completely change themselves, reorganize. It's already happening in China. Some Western cities, in London, go check out Oxford Street. There's only certain vehicles can drive there. Manhattan is talking about stuff. So it will happen, but yeah, cities are going to have to change dramatically to allow for these things to happen, but they will.
Hey, Tom, I do want to end on the Lyft and Uber of it all. In your note, you talk about lowering the estimates for the company's robo-taxi venture, but you're also allocating a bigger revenue share to service providers like Uber and Lyft. Why?
Yeah, so there's like 3 parts of the ecosystem here with robotaxis, right? You have the software, you have the vehicle, and then you have the app. I think there's going to be a lot of software providers. I think Tesla will be a big player in this, but there are a lot of folks making software for autonomy. The vehicle, lots of car companies are going to make the vehicle, but the app, that's one where our analyst, Brad Erickson on the internet team, talks about how that's very sticky. It's a moat. Just look at how you use your apps today, right? Like, how many apps are you going to have on your phone to order a car, right? I have one. And so, that's really, I think, where a lot of the power lies. And that's something that I've raised. And they collect right now for every Uber fare I think you take, I think 25% of it goes to the app, goes to Uber, right? Not the driver. So that's a big lion's share for that stickiness. So that's why we changed our view on that. And we think actually that the app is going to have a lot of power. Tesla is going to make their own app, sure, for sure. But we do think some of these other app makers who already own customers are going to have a lot of power as well.
Elon Musk just won his pay package, Tom, but it seems like he's also on the AI front in his other endeavors, perhaps on a warpath to make sure that he is drumming up some major partners growing forward on the corporate side here. How much of a risk is that for Tesla?
His pay package specifically?
Not the pay package, but when you hear that he's not only threatening to ban his employees from using Apple iPhones and whatnot, but when you hear about him and the other businesses that he is also running where he might get upset that some of the core partners that he's had for years are now cozying up to other partners instead of XAI, for instance. Does that create an overhang for his other businesses, in this case, Tesla?
I don't know about that. I mean, this is a very well-run business. It's not just Elon running this company, right? As much as I think a lot of folks think it is, right? Just go look at the event they hosted in March of last year where they had all those folks they trotted up on stage. I mean, this is a company with some really powerful businesses, not just this robotaxi endeavor, FSD, the energy storage business. So these are, and they're led by some very enterprising, smart individuals that are running these businesses. So I think at this point, he's the visionary, but these are businesses that are run very well by his lieutenants.
All right. Tom Narayan, always a pleasure to speak with you and grab some time. Tom Narayan, who is the RBC Capital Markets lead equity analyst for Global Autos. Tom, great to see you. Thanks. Coming up, everyone, what a sizzling summer means for your electricity bill. We'll tell you how much it'll cost to stay cool this summer on the other side of the short break. We got a fresh read on the housing sector this morning. Home builder stocks falling after the Commerce Department reports housing starts and building permits came in below expectations for the month of May. This is a sign high mortgage rates continues to weigh on home builders and buyers. For more on the sector, we're joined by Bill Pulte, who is the Pulte Capital CEO, and Maurice Austin, who is the S&P Global Ratings Home Builders Director. Great to have both of you here with us today. Bill, I want to turn to you first here. As you're thinking about more broadly what this spells out for the housing sector, what comes to mind when you see softening like this?
I think it's a little bit of a speed bump. The housing market is very strong. It continues to be very strong. And very importantly, the big home builders, and this may sound a little biased, obviously, my family founded Pulte Homes, which is one of the top home builders. But the big home builders have a balance sheet, have access to the mortgage bond market, and frankly, are taking market share right now. So I think that the big builders will be doing fine. It's a little bit of a speed bump, but it's something to definitely keep an eye on.
Well, Maurice, I want to bring you into the conversation because one thing we've been talking about a lot is, of course, the impact to potential home buyers. And I'm curious from your perspective, when we do get that 25 basis point cut, does that lead to just a groundswell in demand that's been pent up over the years during the rate hike cycle?
I don't think so. I think where we are currently, I think the buyers, they've pretty much become acclimated to these new mortgage rates. I mean, obviously 2-3% was at the historic low, but even at 7% historically, those numbers are low from a historic level. And again, even though they've risen over the last couple of years, they are low by historic standards.
Well, Bill, I want to bring you in on that exact question because, as you mentioned, your family very familiar with this as one of the largest home builders in the country. There's also this idea that a cut in rates could lead to more inventory and a potential swell in that. How would your family be responding to a potential rate cut to come?
Well, I'm not with the company any longer, but I will say this, just my own opinion is that the cuts in interest rates will dramatically increase, in my opinion, the price of homes. Because I think what's going to happen is you're going to see people be able to access that mortgage market in a way that, frankly, yes, I agree, a lot of people have become acclimated to the interest rates right now. But if you see a reduction in interest rates, I think demand could potentially skyrocket. And that could be a big problem for affordability. It could be a big problem for people trying to get their first home if you see prices go up even higher than they already are.
So, Maurice, does that signal that for some of the home builders out there, new home builders that have been trying to incentivize buyers to build with them by offering offsets essentially to the mortgage rate, that's going to dry up in the near term?
It could possibly dry up. What we've seen is the level of sales incentives remain elevated, and they will continue to be so as long as rates stay higher for longer, which ultimately could lead to negative profitability on the home builder side.
Right. Well, that's a great point, and it leads to this question about the data that we saw today in terms of just low housing starts and permits. Bill, from your perspective, what would be the single biggest thing that could happen to increase residential construction more? Would that be a move coming from the Federal Reserve, or would it have to be some type of policy move from the federal government?
No, it's a great question. It's a threshold question. It's a question I think you're going to see a lot in this election. But really, the answer is zoning. Zoning is regulation, and there's so many regulations around building homes. These days, people are worried about turtles and birds and all the things that we love. We love turtles and birds. But sometimes if you want a new development, you have to allow for that new development to happen. And you look at a lot of these municipalities and people don't want new homes to be built. So it really is an issue of zoning. And I see that being the only way that this is going to solve. But that's a very, very complicated problem, as you know.
Yeah, it seems like builders in New York are more concerned about alligator or sewer alligators up here. So that is the analogous concern here in a city densely populated as this. All things considered, one of the major things that we're looking at this morning, especially with the new high that was just reported by Redfin in home prices, when should we expect some easing on that front? Maurice, I'll go to you first, and then Bill, you can weigh in as well here.
Yeah, I mean, when you take a look at the increase in home prices, I think part of that as well comes with the limited supply of existing homes. I mean, we know about the lock-in effect where those homeowners that took out a mortgage at 2-3%, they're not looking to sell their homes anytime soon. So that has decreased the inventory for existing homes. So when a buyer is looking to buy a home, he naturally now goes to a new home to purchase. But still, the home price appreciation is having an impact on affordability. And I think that will continue regardless of the mortgage rates.
Right. And Bill, I'll allow you to comment as well, because to Maurice's point, when a buyer is going into the market here, they're considering the reality of what these near record high housing costs are also doing to demand in the environment, and where that's drying up, and still where you've perhaps got the wealthier end that are still saying, all right, we're willing to still remain buyers or remain active, at least in the bidding. What are you seeing?
Correct. And he's right. Maurice is correct. There's basically a new home market, which is like new cars, but for new homes. And then there's the old or used homes. The problem right now is nobody's selling their old used homes. Nobody's selling their old homes. They are selling them, but not to the numbers that Maurice was exactly right on, is saying, is that there's not too much competition. So now you really have to, in order to get a home, you might want to buy a new home. And that is going to keep prices very high. Now, if you see a big fluctuation, or you see a big reduction rather in existing homes, and people start selling those homes, then obviously you could see housing prices go down. But I'll be honest, I don't really see housing prices go down anytime soon. I think housing prices will continue to stay where they're at, if not go up.
All right, we're going to have to leave it there. But thank you so much, both of you, for joining us. That was Bill Pulte, Pulte Capital CEO, and Maurice Austin, S&P Global Ratings Home Builders Director. We're going to be right back with more. Stick with us. This is The Morning Brief. Let's get to some breaking news because the S&P 500 just made another all-time high, crossing the key 5,500 level. The S&P 500 is having its third best month versus the equal weighted index of the S&P, which assigns the same weight to every single stock, since March of 2000, that critical month in which the global pandemic began. You're looking at gains across the board here for the Dow, the S&P, and the Nasdaq. Again, the S&P is up 15% year to date and just crossed the record-breaking 5,500 level for today. Now moving on, hotter temperatures are expected to send residential electricity bills higher by an average of 3% this summer. That is according to data from the Energy Information Administration. Nez Frey is here to break down the reason behind the jump and the impact it could have on prices. And Nez, what do you have for us?
Yeah, so what we're talking about are really the summer months, which would be June, July, and August. And monthly electricity bills on average are expected to be $173 in the U.S., although that's not my bill. A bit higher than the $168 last summer. Almost 90%, by the way, of households cool their homes with air conditioning. So it's supposed to be a hotter summer, and that means that residents will be consuming more electricity, and that increased consumption will partially be offsetting those lower residential electricity prices. Now, I want to pause for a minute to show you where we are going to see some higher prices versus lower prices, because the Pacific Coast states, those are likely to see the biggest increase in electricity prices, up 7% this summer. And in New England, you're likely to see lower electricity prices, down 7% compared to last year because of lower natural gas prices. Now, I do want to say the caveat that New England's average electricity prices are still very elevated compared to the rest of the country. In other parts of the nation, the cost is 26 cents per kilowatt hour. One point to note also is that natural gas prices have declined since last year. They're lower than at this time last year. And that's a big component to make electricity. But the transmission lines, upgrading, maintaining the grid, that is more expensive. You guys, one silver lining is that now energy units are more efficient. So your air conditioners tend to be more efficient. The EIA is forecasting that residents will be consuming less in that sense because of these more efficient air conditioning units.
All right. I hope mine is one of those more energy efficient
right?
ones.
Well, compared to last decade, to the 2010, they're comparing it to. So yeah, over time they've gotten better.
Excellent. Yahoo Finance's own Nez Frey. Thanks so much.
Thanks, guys.
Thanks, Nez. Well, President Biden and former President Trump are set to face off in the first presidential debate of this election cycle in about 7 days here. As the election gets closer, Goldman Sachs out with a new note arguing that investing in gold could be a hedge against any potential volatility heading into November, particularly in the event of a Republican sweep. For more on this, we bring in our very own Rick Newman. Rick, great to have you with us in studio. Gold as a safe haven. What a novel concept.
Yeah, let's examine the interesting premise here, though. So gold is, usually analysts don't tie gold to some political event. It's some kind of upheaval in the economy. And the premise behind this Goldman Sachs research is that if Trump wins, and especially if Trump wins with a Republican Congress, in other words, full-on Trump Republican agenda, we're going to have more inflation than if we were to have a split government or if Biden were to win. And a lot of people might be thinking, wait a minute, I've been hearing about Biden inflation for the last 3 years. Do I now have to worry about Trumpflation? And the answer is yes, you do. So look at some of the things Donald Trump wants to do. Number one economic agenda item for him is more tariffs on imported products. Tariffs are a tax that raise the price. Rising prices equals inflation. It really doesn't get any simpler than that. And then there are a couple of other things a little more complicated, but Trump has talked about trying to exert political control over the Federal Reserve. We know he strongly favors lower interest rates rather than higher rates. That is the opposite of how you get inflation under control. That's the reason the Fed's been raising interest rates for the last 2 years. And then Trump seems to have no concern whatsoever about the $33 trillion national debt. He wants to cut taxes even more, add more to the debt, and that is potentially destabilizing for financial markets. So all of those things, that's the premise behind Goldman Sachs saying, wow, we might have more volatility, more inflation if Trump wins, and especially if Trump wins with a Republican Congress.
Right. Position into gold is typically a strategy, an investment strategy that you see deployed when there is more time of geopolitical concern here. So that tying directly back to where Trump would say, okay, I want to lower taxes or have no taxes, but ramp up or ratchet up tariffs, as you were mentioning, that almost just gets you back into that same mindset of what are the geopolitical, what are the broader kind of international business concerns that could then come to light as a result.
Yeah, and polls show us that Trump has a better reputation for handling the economy than President Biden does. And polls also show that a lot of Americans think of the Trump years as a stable time for the U.S. economy. Of course, that's before COVID arrived in 2020 and changed everything. And they're sort of right about that. I mean, we didn't really have any inflation to worry about during the Trump years. And so people say, well, Biden became president and then we had inflation. Therefore, the very simple and frankly too simple logic is Biden created inflation. That is not the case. It is a much more complex world right now. Supply chain snafus related to COVID had a lot to do with inflation. That wasn't Biden's fault, and Trump is not going to undo those sorts of things. We have two wars going on, potentially widening war in the Middle East, a lot more edginess in energy markets because small developments based on where we are right now could have an outsized effect on prices. So Trump is not going to come into office and just magically overnight we're going to go back to 1.7% inflation, which we had during the Trump years. That is not going to happen. This is where Goldman Sachs is coming from, telling their clients, let's try to get ahead of this and anticipate what might be coming.
Great overview as always, Rick. Thank you so much
Thanks,
for
guys.
joining us. Really appreciate it. Coming up here, we are going to dive deeper into the catalyst driving the market rally. Later, we're going to speak with Needham analyst Laura Martin on the bull and bear case for Reddit. All this and more on Catalyst. Stick around next. 10 a.m. here in New York City. I'm Madison Mills alongside Brad Smith. Let's dive into the catalyst moving markets today. No surprise, the big one here, Nvidia, the chip giant, overtaking Microsoft in market cap, now becoming the world's most valuable company here in the U.S. There appear to be a few catalysts that could slow that rally, but it's still powering the S&P to a new all-time high of 5,500 this morning. We'll discuss the implications.
Plus, a fresh read on the labor market. Jobless claims coming in higher than analysts expected, but declining from the previous week's revised levels. Now, the data reaffirming that the labor market is showing signs of some cooling, but overall, it remains strong.
And we're also watching the great rate debate play out globally as central banks around the world, like the Bank of England, holding rates steady at a 16-year high. Meantime, the Swiss National Bank is making its second interest rate cut of the year, citing a drop in underlying inflationary pressures. We're going to discuss the impact this could have on the Federal Reserve's decision here in the U.S. But first, we've got to get to our top story of the day, which is Nvidia, the chip maker, now the most valuable company in the U.S., surpassing Microsoft with a market cap of more than $3.33 trillion. Nvidia bulls can't get enough of the AI wave, but what could derail the potential rally? One concern is valuations. Stacey Rasgon, Bernstein managing director and senior analyst, recently told Yahoo Finance that Nvidia's upcoming earnings expectations could be a concern.
As we get closer to earnings and other things, how high do expectations go into those prints? And then, like, what do things look like relative to those expectations? That'll be the worry for the next few quarters. But the raw numbers themselves, I think, should be fine.
So it continues to be this question of valuations. But when you look at a company like Nvidia and the PE ratio, it does support the high valuation. They continue to deliver on the fundamentals. So this big question about valuations doesn't necessarily hold a lot of water when the company continues to deliver, Brad. Having said that, an interesting note from Barclays this morning saying that there are, quote, reluctant longs on this market. This idea that you're kind of grinding out your continued rally to new all-time highs like we saw this morning, but it doesn't really feel that comfortable when you've got so much concentration in just a couple of names. That's a lot of risk, basically riding on Nvidia and Microsoft.
And it really does come back to what their market share profile looks like going forward from here. I mean, as of right now, they could perhaps, and based on some of the conversations we've had with some of the most bullish analysts on this company going forward, if they maintain somewhere about 80% of the market share that they do have in this chip segment, especially considering the de facto play or the de facto kind of annexation that they've received from some of the Goldman Sachs's of the world, the de facto play in generative AI. For Nvidia, if they're able to maintain about 80% of that market share, then that puts them in firm positioning to really just continue to grow on top of the portfolio of clients that they do have at the same time, where many of those clients are going to see a massive ramp up in the amount of chips that are necessary in data centers. You think about the current profile of some of these data centers, looking at about 60,000 chips in a data center. We could get to, and this is from Nvidia and what they've talked about on earnings calls and some of the analysts as well, we could get to 1 million chip data center at some point, and Nvidia is certainly banking on that.
It's a really great point, Brad. And what are you going to tell clients? I'm not going to get in on the tech trade. That's just not going to work. So it's a really great point. Thanks for joining me on that here. We're going to zero in more on global central banks. England and Norway central banks holding rates steady this morning as the Bank of Switzerland made its second cut of the year. Here in the U.S., traders pricing in September for the first rate cut. That's according to the CME Fed Watch tool. Here to discuss the global divergence that we are seeing, we have Christian Nolting. He's the Global Chief Investment Officer at Deutsche Bank. Christian, thank you so much for being here. I mean, let's start on this domino effect that was supposed to be kicked off here, right? Allegedly, it was going to happen in Europe after the Swiss National Bank started. Now it's continued. Norway didn't follow. Neither did the Bank of England this morning. Are these international central banks kind of waiting on their own inflation data to come before continuing to cut, or are they waiting for the Federal Reserve?
Yeah, you would always have said probably the ECB always wants to wait for the Fed to cut first, which historically has been the case. Now you've seen the ECB cutting first. I think what the central banks need to do to look, indeed, as you're saying, at their own economy and what they need to do. So what's the inflation picture? And I think especially for Switzerland, right, they have cut also to weaken the currency a little bit because inflation was not the massive problem in Switzerland. So they had some room to go. And they achieved that with that. So, but in the last weeks, the currency was strengthening. So I think that opened for them to cut one more time here, which they did today, and you see the currency weakening a little bit in order to get, again, some inflation in, because it's not that they are so much worried about inflation. That's probably different in the US, where, of course, you need to look from a Fed perspective. That's also our view. Inflation is quite sticky, so you cannot just cut 6-7 times as the market was pricing at the beginning of the year.
What do you make of the staggering that we may see in rate cuts going forward, Christian?
Yeah, I think central banks will have the room to cut, but we are a bit cautious that there are many cuts to come, because I also think we are not in a situation where the central banks are fearing a massive inflation coming up, and hence you see a full cutting cycle. On the opposite, right, we are seeing inflation is quite sticky. The labor market, as you just mentioned, not only in the US, by the way, also in Europe, is quite sticky, stable, which, by the way, is not the worst news. So from that perspective, why would you cut so much as a central bank? So we think over time, and maybe that's 1 year time horizon here I'm talking about, we could imagine that central banks like the Fed, like the ECB, are cutting 3 times over the next 12 months. So that's a little bit our projection.
Well, I also want to talk to you about the global election picture and the volatility that could cause for markets. It did seem like the French election outcome, particularly the snap election move from Macron, did take people by surprise. Which upcoming election globally are you telling clients to prepare for, to not be taken by surprise for the potential outcomes?
Yeah, guess what? I think it's the election in the US. Although, of course, there's a lot of interest here in election in France. You've seen spreads between French OATs and German Bunds are widening to literally record levels. Last time we've seen them at these spread in 2011. So there was, of course, some anxiety about what happens to markets then. Then there's the UK election coming up, also very close on July 4th. But what I discuss with clients and where they ask most is and remains the US election, I think, quite clearly.
Well, it's interesting you bring up the U.S. election. In our final minute here, I'm curious from your perspective. I mean, every leader does kind of want to avoid a Liz Truss moment where you bring out the bond vigilantes. Do you think that could make leaders who do come in a little bit more moderate than what the market may be pricing in?
Yeah, I think yes, absolutely, because you have seen now statements also from France, from different parties. We will, of course, need to look what's going on. You see that in the UK. And of course, US, I wouldn't be surprised to see, let's say, very surprising immediate reactions after an election. So from that perspective, yes, I think there was clearly a learning, and I would be really surprised if there's immediate action coming. And by the way, in France, it's not even possible if there's a change in government. There needs to be some time to build some things in. And from that perspective, I wouldn't call for next day immediate volatility.
All right, we're going to have to leave it there, Christian. Thank you so much for joining us. Great insights. That was Christian Nolting. He is the Global Chief Investment Officer at Deutsche Bank. Now, we are less than 5 months away from the U.S. presidential election, just a week out from the first debate of the cycle between President Joe Biden and former President Donald Trump. So how are investors preparing for the matchup? Yahoo Finance senior columnist Rick Newman is here with the breakdown. Rick, what are investors taking a look at here?
Lots of things. Tax policy, tariff policy, who would be better handling with inflation, which we've talked about recently. I mean, I think one of the big things that is really starting to come into focus are the Trump tax cuts that expire at the end of 2025. And there's going to be a big difference between whether Biden is president or Trump is president. It also matters who controls Congress. And there are basically 4 scenarios. Biden gets reelected with a full Democratic Congress, pretty unlikely. Biden gets reelected with divided Congress. Trump gets elected with full Republican Congress and the full Trump agenda, or Trump gets elected with a divided Congress. And those, whichever of those scenarios we end up with is going to have a lot to do with what happens with the individual tax cuts that expire at the end of 2025. Just to remind people, the corporate tax cuts that Trump put in place in 2017, cutting the rate from 35% to 21%, that's permanent. Nothing changes about that unless Biden wins with Democrats and he's able to raise it, which he has already tried to do and been unable. But all of the individual tax cuts expire. So if Congress doesn't do anything about that, it's a de facto tax hike for most Americans.
Yeah, and as you mentioned earlier, it can be inflationary as well. So people should definitely check out Rick Newman's byline and look at kind of the multitude of coverage that you've got coming for us. Rick, thank you so much for joining us. We really appreciate it. That was our own Rick Newman. We're going to have all of your markets action ahead ahead right here on Yahoo Finance, so stay tuned. You're watching Catalysts. Take a look at some trending tickers that we are watching this morning. Kroger beating on estimates on the top and bottom line in the latest quarter earnings as more shoppers visited its stores as food prices starting to level out. Our very own Kroger beat reporter Brad Smith is still with me to discuss this name. It's interesting, we're seeing shares kind of fluctuating a little bit this morning off of this mixed report, Brad. It seems like EPS, identical sales beat estimates, but we had muted gross margin growth. What are you looking at in this earnings print that sticks out to you?
Yeah, just to put a number on that gross margin, it was 22.4% of sales for the first quarter here, and excluding fuel decreased by about 7 basis points compared to the same period last year. And they said that the decrease in that rate was primarily attributable to lower pharmacy margins, increased price investments, and then partially offset by some favorable product mix reflecting their Our Brands margin performance. And you think about that particular part of the business too, for Kroger and for Walmart, for Target, many of them leaning into so many of these homegrown brands as well, where consumers are pushing back on price for some of the other sourced assortment and mix that Kroger, Target, Walmart, especially within their own positioning, I'll throw Whole Foods in there as well, all of them have leaned into those larger brand and considerations and partnerships over the years. So all of those things considered, leaning more into the homegrown or the private label. And then additionally here, one of the other considerations that this company is talking about is the macro here. trying to deliver value at a time where many consumers, they're saying, need it more than ever. Affordable prices is what consumers are looking for. They're looking for personalized promotions as well. So those promotions certainly can put a dent in some of that margin element that we started off this conversation with here. And then also just talking about some of those investments, just putting a little bit more color on that, trying to make sure that even despite whatever economic cycle that they're in, that they're investing further in the employee experience, which is really interesting to hear from the company here, trying to make sure that they're also retaining a certain base of employees operating these stores and knowing how much they need to deliver upon. And then just lastly, one of the sexiest parts of the business for me, yes, groceries can be sexy, especially when you think about the digital sales components of how people are engaging, whether that be buy online, pick up in store, or having somebody pick and pack and then just bring it to you or deliver it to you. Digital sales grew more than 8%, delivery and pickup combining for double-digit growth right there. So, all right, I've exhausted the word count on this one, but that's Kroger for you right now.
I love it, and it's a great point, Brad, because the grocery market is definitely a look at the consumer and a look at our economy and a look at the Fed. It tells us a lot, so appreciate you joining us for that. Thanks so much, Brad, and thanks for joining me at the top of our show. We appreciate it. We are moving on to KB Home shares. They're in the green after the company beat earnings estimates on the top and bottom lines. You're looking at a stock that's up a little bit over 4.25%, nearing 4.5% here. The company raising the lower end of its housing revenue guidance as well. Yahoo Finance's Danny Romero joins me with more. Danny, I know you cover the housing space for us. Tell me what stuck out to you in this earnings print.
The new home market is the winner here, and KB Home really reported an impressive second quarter earnings. Now, there are some takeaways from what KB revealed in its earnings about the state of the housing market, and so that's really kind of crucial here. Mortgage rates are still to blame. They are the problem in the housing market, especially as we are waiting for this recovery to materialize, which is pushing a lot of buyers to the sidelines. Now, with that in mind, incentives are not going away. So the popular mortgage incentive has been the mortgage rate buy downs. That's when the builder upfronts the cost to lower the rate on the loan. That has been a very popular incentive for entry level buyers. And KB Home is specifically geared towards entry level buyers. They also revealed a little bit about their customers. So who is actually buying these homes? It is buyers who make $130,000 a year. And that really stood out to me, that it really sits on that higher end when it comes to the income spectrum. And they're also putting about 70 grand as a down payment. So that was a little bit of revealing a little bit of who is the customer right now buying a home. Now, the other thing is mortgage rates have pulled back. So does that mean that this home builder or more home builders will also pull back on incentives, which has been squeezing some of the gross margins across all home builders? KB Home revealed that they could see some pullback in incentives. Now, that all is dependent on mortgage rates, of course. But again, remember, the interesting part of all of this is that if mortgage rates do come back, it could spark some competition in the resale market. And what does that mean for home builders? And KB Home pretty much said, we're not worried about the competition here. If there is more supply that gets added to the resale market, we are good and we are in a good standing here. And we know that we will still be able to take the market share of the buyers that are interested in the housing market. So that really did reveal to me that the new home market is still a winner here.
Still a winner, and especially given the amount of competition in the space, it's really interesting to see that. Danny, thank you so much for bringing us your reporting on this name. We really appreciate it. Thank you so much. We're moving on to another name here. Shares of Darden restaurants moving higher this morning after the company beat earnings estimates, up a little over 1.5% there. Its acquisition of Ruth Chris Steakhouse fueled a 6.8% jump in net sales. For more on this, we're going to bring in Gregory Frankfurt. He is Guggenheim Securities Senior Analyst. Thank you so much for being here with us, Gregory. Listen, I'm really interested in this because you're trimming your estimates and price target on Darden slightly, but you still think it's one of the highest quality assets in the restaurant space. Talk to me about the single biggest driver in your decision here.
Sure. So we trimmed estimates into the quarter, and the company just reported this morning same store sales of flat, which was a little bit below consensus. Earnings was a little bit above consensus as margins beat. And one of the things that I think is interesting is Darden is the best bellwether for full service restaurant stocks in the space that we cover. They've continued to see a little bit of pressure on the low end consumer. But one of the things that I thought was really interesting from the earnings call this morning was that they're actually seeing a little bit less check management on the business as a whole. So a little bit less people or fewer people removing a drink, removing a side. Mix was actually relatively flattish in the quarter. So we're getting a very mixed read on the consumer where sales are still a little bit soft, but maybe there's a little bit of glimmer on the margin and on check management side of things.
Gregory, let's dive into that because just in case Fed Chair Jay Powell is listening to our program right now and getting great insights from you, I want to make sure that he understands. So it sounds like the lower end consumer is changing ever so slightly, but the overall consumer picture looked pretty okay for Darden. Am I understanding that correctly?
Yeah, I hope Powell listens to us, but we'll see. So this has been the restaurant sector has been under quite a bit of pressure the last few quarters. And Darden is one of the ones that reports off cycle. So we get a different read. They're the biggest full service restaurant chain in the public markets. And so what they say matters. And they've taken a strategy where they've actually underpriced their competitors by about, 6-7% over the last 4 years. And the sales have kind of been okay. They've seen some traffic outperformance, but generally their view on the consumer has been that the lower income has been under a bit of pressure, and they've seen a bunch of consumers electing not to have a drink, electing not to have a side. But this quarter was a little bit different. We kind of saw that neutralize, and maybe there's a glimmer of hope from that perspective. And then we'll be watching that when we get the rest of restaurant earnings coming through in the next month or so.
Well, Gregory, another thing I want to talk to you about while we have you is this sort of value meal war that we are starting to see amongst some of the more fast food and quick service chains here. I'm talking about a McDonald's, Burger King, and Wendy's. They've got these more affordable combo meals that they are pushing into the market to kind of drive forward this idea of affordability. What is that telling you about the state of play when it comes to the fundamentals at these businesses and whether or not that's going to be a good business decision for them moving forward, or is it something that could potentially be a headwind on their profit margins?
Yeah, I think what's driving this is it's been a very challenging inflation backdrop for restaurants to manage the last few years. You've seen mid 20% stacked food inflation, a similar level of labor inflation. And so restaurants have had to take a lot of pricing. Now you're in an environment where labor inflation is still going up 4 or 5% a year. But food inflation's been kind of flattish. And the franchisees and franchisors have a little bit of a different approach where the franchisees are trying to drive bottom line profits. The franchisors are trying to drive sales. And so the sales have been a little bit soft, and they're trying to get the franchisees to be a little bit more restrained on their price increases. And so I think disinflation, where we're seeing less inflation than we saw 6-12 months ago, the franchisors are trying to rein in the franchisees and how much pricing that they've been taking. And so I think that's what's playing out. You've seen margins up quite a bit the last 12 months. And I think this industry is too competitive for industry-wide margins to structurally be higher. And you're seeing that competed away a bit.
Absolutely. And just to put a button on that, the president noting and the company's prices for McDonald's increasing by an average of 40% since 2019 across those franchises to offset those rising costs, and customers certainly taking note of that. Gregory, thanks so much for joining us this morning. That was Gregory Frankfurt. He's Guggenheim Securities senior analyst. Now coming up, Reddit is getting a bullish call from Needham. We're going to speak with the analyst behind that call after the break. Reddit shares are up over 20% since the company's public debut back in March. Our next guest, though, thinks there's more room to run, hiking her price target on Reddit from $63 to $75 on the heels of its new OpenAI deal, along with some upcoming data licensing agreements as well. Joining us to discuss, we've got Laura Martin. She's Needham & Co.'s senior media and internet analyst. Laura, thank you so much for being here. Let's talk about Reddit, because as we mentioned, you rose your estimates and price target on the name. What is the single biggest driver of that upgrade?
Other revenue, which is their generative AI licensing fees. So they did about 1 million conversations a day and 7 million comments. And all of these Gen AI large language models need to not only understand pop culture English when you ask them a question, but they need to answer in a way that sort of keeps up with the changing English language. And so the best place for real human conversations is the Reddit daily update of these real conversations in real English.
Yeah, we have these continued conversations on our show about where you see AI plays that make sense and are really fueling company fundamentals versus just kind of a mention of AI on an earnings call. It sounds like for you, the AI play with Reddit is one that could lead to a fundamentally better business.
I think so. The margins here are 90% when they do one of these licensing deals, and they already have a $200 million deal with Google, or Alphabet, I guess their LLM is called Gemini over at Alphabet. And then they just got another $200 million deal from OpenAI, Sam Altman's company that Microsoft is the big investor in. I expect all the Amazon large language models and the Meta large language models to also license the Reddit conversations to keep up with changing English.
Real quickly, how concerned are you about the saturation of Reddit users so far?
You know, they're going global. About 50% of their users are global, and they're acceleratingly adding users. So their user growth has like doubled in the last 2 years. So all of that bodes well for more users coming on board, which gets you more conversations, which should be a flywheel to attract the next user.
Well, another company that I know you cover is Apple, Laura. Right before this recent rally that Apple had, they had just broken above the flat line for their year-to-date performance. Now they're up about 14% year-to-date. I'm curious from your perspective, is the post-Worldwide Developers Conference growth real, or does it start to fade, particularly after we get the upcoming quarterly earnings from Apple?
Right. So, I mean, the reason the market is saying that they think the generative AI announcements that Apple has made will actually drive faster iPhone sales that are in any of Wall Street consensus estimates. So I think they're too early. I do not think that will play out in the current iPhone that gets launched in September. Especially because you saw today, the headline was that Apple needs a large language model in China because China doesn't allow any of the large language models that are sitting in America to be used. So none of the Gen AI stuff they announced are allowed in China, and that's 20% of iPhone sales. So I think this cycle is too early. So we think actually estimates will not exceed Wall Street consensus this year, but next September, we do think a lot of developers will integrate the Gen AI capabilities Apple is talking about. So the next cycle after this one, we do think is probably our estimates are too low. But I'm not as optimistic as the market today is about the September of 2024 iPhone cycle.
Well, it was interesting because initially after the conference, there was kind of a tepid Wall Street reaction on Apple. And then the next day, after we got some commentary from folks in the space, it seemed like there was this sudden rally around all of the announcements that they made. I mean, I'm just curious, what did you think of the announcements? Did they pass the sniff test for you?
You know, I think so first of all, Apple, as you know, has a $100 billion share buyback. And so my guess is they're in the market supporting the shares here. That would be my guess. And then secondly, I think it's just all a judgment, and people are trading on how big iPhone sales will be, because that's 50% of their revenue still, this September. And it's my judgment that Gen AI won't be as big a deal this year, but the market disagrees with me. They think that these Gen AI announcements are going to drive iPhone sales this September and October.
Well, that's what makes conversations with people like you fun, Laura, so we appreciate you having an interesting take. I do want to also get another company name in here. Laura, you also laid out the bull and bear case for Netflix in a recent note, the stock continuing to hit all-time highs right along with the broader market here. How much more room to run do you think Netflix has moving forward?
They announced today that they're going to do their own version of physical, I'm going to call it theme parks, but it's more like a house where you go and you can do selfies. They were demoing it at the upfronts, where you can go and inhabit all of their hit shows in real life. So it's their version of a theme park. So they're sort of copying in a low capital intensity way. They're copying the Disney playbook, more merch, more video games, more. So that's sort of interesting. They continue to do innovative things. I think the return on capital for some of these things is unknown and unproven, but they're really innovative. And I think that's interesting. They do it all their own way. But so I think they're, what the greatest thing about Netflix right now is that they're buying sports rights and not increasing their content budget. And investors strongly believe that the return on the upside value from a sports activity is much higher than another dollar spent on entertainment content, which we sort of think is oversaturated and commoditized.
Well, as you mentioned, live programming a big catalyst for Netflix, but to me, profiting off live programming sort of requires advertising, and sports itself just sort of requires advertising within it. What do you think that means for Netflix's ad tier offerings? Could you see a future where they don't offer an ad-free option for subscribers?
So the Wall Street loves dual revenue streams. No, I think all these streamers will end up just like the cable business was, 50% ad driven, 50% subscription driven. It'd be silly to actually only have a single revenue stream. Wall Street hates that because of the lack of diversification. So no, I cannot see that. Whilst there are customers who will pay a lot of money to not have ads, usually rich people. So no, you should offer them that if that's what the consumer wants. So no, I think these streamers, including Netflix, will end up in the end with 50% ad revenue, 50% subscription revenue. And Wall Street likes that kind of mix best.
Laura, really appreciate you joining the show. Thank you so much for the great conversation. That was Laura Martin. She's Needham & Co.'s Senior Media and Internet Analyst. Now, coming up, more of the coverage of our Cannes Lions International Festival. Yahoo Finance spoke with celebrities, business leaders, everyone in between, mingling over in the south of France. Our very own Brian Sozzi sat down with Kevin Mayer, Candle Media co-CEO and founder. We're going to bring you that interview next.
All right, one of the most in-demand executives here at Cannes Lions is no doubt Kevin Mayer, Candle Media co-founder. Good to see you. Looking good in that jacket, sir.
I'm feeling a little hot in this jacket.
You knew
but
I was
it's
going to
great.
reference it.
You're looking good in the shirt.
Well, the last time I
have to
saw
say.
you was at the Yahoo Finance 2023 Invest Conference.
It
A lot
was
of
a great-
newsmaking there.
That was a great conference, great newsmaking.
Yeah.
Thanks for having me.
I appreciate that that shout out. So what brings you to Cannes? How is your week looking so far? And what is Candle Media up to?
Well, we're up to many, many things. The biggest part of our business is actually a YouTube presence that we have with some of the biggest kids IP in the world. Cocomelon, for parents out there that have small children, they'll know who Cocomelon is. They'll love me or hate me, but I think love me more than anything else. Blippi and a whole bunch of different properties. Those are all ad supported as well as streaming, licensing to streaming services. So I'm here meeting with a bunch of advertisers, seeing the creativity that's out here. Come here every year. It's a really great event.
What's your vibe on the advertising outlook? Of course, political year could be a nice little boost for many linear networks, but what's your feel of it?
Well, I feel it's definitely a political year. It's going to be a big political year for sure. I do think the advertising's on the upswing. You know, it's very cyclical and it follows the economy. The economy was a bit in the doldrums for a couple of years now, but it's coming out. I guess we didn't have an official recession, but we had close to it. So
We're still waiting for one. And maybe it'll happen next year.
It'll happen at some point. There always is one at some point. But I think the ad business is doing pretty well, and I do think it's shifting though. There's a big mix shift afoot in advertising. I think advertisers are seeking high-quality video environments, which they've always had in linear television, but also coupled with the ability to at least lightly, if not really in a deep way, target their advertisements. So I think these interactive platforms, I think fast channels, I think all the over-the-top ad-supported services, most streaming services now do have ads in their mix. I think that's where the advertising dollars are flowing. Linear TV is still important, has a lot of reach, has some of the highest quality programs in the world. So still important, but I think you're seeing this targetable media coupled with great environments. That's the thing.
Do big brands want to see their name in an ad after the first debate on CNN? Isn't there a risk to putting your name out there?
You'll have to ask the brand. I don't know. Those debates can be pretty interesting.
I think it's going to be interesting
It's
on
going
the
to be
27th.
interesting. I'm looking forward to watching them. I think the one thing I will say, people are pretty engaged in those debates. It's not a lean back experience. So I think advertisers that do end up there and have the fortitude to stick with it will probably be paid off with a decent amount of recognition and engagement.
You have really an extensive streaming background, helped launch Disney Plus. What is the outlook for linear TV? If we're having this conversation 10 years from now, what does the local TV station look like?
Well, linear TV is in secular decline. I think there's no question that at least the pay TV elements of linear television are being supplanted by streaming. And I think that, the last bastion of pay TV has always been sports and news. News you can get in a lot of different streaming, and you can get them just on the web, and you can get news in a lot of different places. So I'm not sure that's going to continue to be a major driver of pay TV. So it's really down to sports. And I think, ESPN's announced that they're going over the top with their sports streaming. They're in a joint venture with Warner Brothers and Fox to do the same thing. I think that you'll see sports migrating from pay TV in a very substantial way, also to streaming. So I think the outlook for pay television isn't great. And when sports viewers find other opportunities to watch sports, I think you'll see a continuation of that decline and a collapse, frankly, of that environment. But broadcast is a bit different. That doesn't depend on pay TV to get delivered to households. They're in every single household. And I do think you'll just see a different type of programming coming in there. You'll still see sports on broadcast. You'll see news, of course. And you'll see a bunch more reality programming, less expensive programming. I think the days of very expensive, high production value scripted programming on linear television are coming to an end.
I hear what Disney and Warner Brothers teaming up to launch that streaming sports, that package or platform. But do we need another streaming service in our life? And is what they're doing something that a Netflix and Amazon should have just got into and just totally own the ecosystem?
I don't think that Amazon and Netflix should have gotten into that. I think sports are a very, very interesting and differentiated type of programming. They're very expensive. They appeal to a subset of the population, but not everyone. I think, big time sports fans are probably less than 50% of households, would be my guess. And for years, one of the reasons pay TV is in such secular and substantial decline is the cost of those sports rights. And everyone had to bear the cost of those sports rights. So you had every consumer, almost every household had pay TV 10 years ago, and everyone was paying not only for the entertainment that they loved, but also for sports, and not everyone watched the sports. And I think that helped drive the decline down. People were paying for something, and a very expensive thing that they didn't really want to watch. So I think Netflix will put their toe in the water, but they've become a very successful entertainment company without sports. They have sports-related programming, but not the actual sports rights. I don't think they're going to get into it in a big way with the major sports rights. I might be wrong.
I'll say, can linear hold these sports rights? They continue to go up. I mean, linear, the cost is going up. The balance sheets for the likes of the sports broadcasters are getting, they're not where they need to be. And the biggest companies with the biggest cash coffers are, in fact, Amazon and Netflix.
They are Netflix, Amazon, Google,
and Google.
You know, the big tech companies. And Amazon has proven once again that they are interested in sports rights. They're bidding on them. Rumor has it they're in the NBA this time around. Don't know if that's true or not. They obviously have football. They have a lot of sports, and they have sports internationally too. I don't know how much more they're going to do in sports. It has to feed their ecosystem in some way. The direct revenue of sports through their advertising business, and it's a big advertising business, I doubt it covers the big major sports. But I do think that there is ancillary benefits to companies like Amazon and Google. It brings people to the ecosystem, has a lot of engagement. It's a brand deposit in a very big way. So I think they'll still be in it. I just don't know if there'll be a wholesale shift away from traditional media to digital or not. It's yet to be seen.
Last time we talked to you at our Invest conference, you were advising Disney CEO Bob Iger. Are you still advising him? And then when he's no longer the CEO of Disney, what does Disney look like? Does he have that one more Iger moment where he makes some form of big strategic change?
I'm still advising, so I can't speak too directly about it, nor should I. But I'd say, Bob's there for 2.5 more years. He has plenty of time. He has a good deep bench there. They have a very, very solid management team across the board. So I think that he has succession well in hand, I would guess. Again, I'm not involved in the process. And do I think he wants to do one more big thing before he leaves? Possibly. I don't know what that would be exactly, but he's made some investments recently, and I think that there's probably a little more to do. But he might just leave in 2.5 years and leave it to a successor to make a big change. I'm not sure. It's in good shape. Disney's in actually very good shape. The stock price hasn't quite reflected that yet, but I think it will. And I think this weekend with Inside Out 2 is a huge win and a much needed win for Disney.
Two-parter. One, do we know who the Disney successor is this year? And then what characteristics are they looking for? And how is the process, I guess, different than the last time Disney went through the process?
Well, I'm not sure. I'm not privy to their succession process. So but I do think the board is going to be quite involved, as good governance would call for, and I think they were last time too. I think we may know this year, but he has a 2.5 more years, so it wouldn't surprise me if it extended a little bit beyond this calendar year into next calendar year. But in the not too distant future, he's going to want to make it known who his successor is. So he has some time to spend with him or her at the helm. I don't know much more than that, and I don't have a huge amount of insight. I think the succession process will be very clean and very good this time around.
You're also the former CEO of TikTok, and we've talked to a lot of creators here on the ground, and gosh, they're just a passionate group. They love the TikTok platform, but Kevin, if this gets banned in the US, what happens to this community and where do they go?
This has been such a strange process. When I was there in 2020, we had to run through the same thing. That was a little easier to navigate, though, in hindsight, because they were presidential decrees. Trump had some decrees and said, we're banning TikTok, and he didn't have the weight of the legislature behind him. And now, of course, it's a validly passed law, both houses, and it's signed by President Biden. So it looks a little more difficult, their path at this point. Now they can always sell, or something can happen and the law could be overturned in the courts. That's also possible. Again, I don't know what the outcome will be. I think it's all a bit, and I'm going to use the word silly. It's hard for me to contemplate TikTok being that big of a.
Well, is a ban a good thing? Is it good for?
No, it's not. No, I don't think it's a good thing. I don't, and I think TikTok is a great service. I think TikTok has been separated from China in a large way. I think they're based in Singapore now, and they're largely separated at this point, if not fully. I'm not at TikTok now. I don't know all the facts, but it's a good platform. It's more than a good platform. It's a spectacular platform. It does things that others can't. The AI that it uses both to create all the lip syncing and all the things it does with AI on the creation side, but also on the curation side. The For You page is nothing but a vastly efficient, incredibly insightful AI engine that knows exactly what every single user wants and in what order and what to show them next, and does a lot of A/B testing throughout the process. So they have an incredible platform. If they do get banned, or if they get banned, I think there are two companies that are going to really benefit from that. Everyone talks about Meta and Reels, and that's for sure they're going to benefit. But I think YouTube is probably the biggest beneficiary. I believe it's true that YouTube Shorts has even more monthly active users than TikTok around the world in that vertical video format. And I think they've done a great job. I love Instagram Reels too, but those two will share the spoils should TikTok get banned, which I hope they don't. I think probably YouTube benefits a bit more.
Lastly, real quick, before we let you go, Paramount, this has just been a true disaster story. I've never seen anything like this, Kevin, but is there another buyer potentially coming in here, or has this brand now been harmed beyond repair just given the process they've gone through?
It's been a very strange process. People I know and respect a lot have been in it. You know, Redbird with Jerry Cardinale almost got the deal done, and David Ellison, great guys, really smart guys. Very surprised that Sherry at the end didn't decide to take that option. You have Apollo and Sony that are knocking on the door. I think I've seen in the press a couple other potential suitors that are out there. But I will say Paramount as a company is quite impaired at this point. They have, 3 CEOs running it, a broken, it looks to be, maybe it will resurrect, but a broken deal process, and a business that's just not doing all that well. So I like Sherry a lot. I think she'll hopefully figure out what to do here. But as of right now, it's a big, strange problem.
To put it mildly. Kevin Mayer, we'll let you get back to the party and meeting scene here at Cannes Lions. Thank you for always making time for Yahoo Finance. We'll talk to you soon.
Always for you, sir.
I appreciate it.
All right,
Thank you.
Commercial real estate market continues to be a volatile sector as U.S. office values are 25% below their 2022 peak. Now Moody's is warning of potential downgrades for 6 regional banks that have commercial real estate exposure. Despite this, our next guest believes that the bear market could be a great buying opportunity. For more, we welcome in Barry DiRaimondo. He is SteelWave's co-founder, chairman, and CEO. Thank you so much for being here in person with us. So we set it up nicely there for you. A lot of obstacles in the CRE space, but you're seeing opportunity.
I am. I think you're being generous when you're talking about values. Candidly, I think in the office sector, I think values are down 50 to 70%, not 25%. So depending on which side of the sale you're sitting on, if you're sitting on the seller side of the equation, you're probably a little concerned. If you're sitting on the buyer's side of the equation, you're probably looking at the opportunity as being generational in nature.
So getting in while it's inexpensive, but for
Exactly.
what?
Well, you've got two sides of the equation. You've got the capital market side, which drives values, and then you got supply and demand, which drives leasing. And they're both a mess, candidly, at the moment. And the institutional capital world doesn't want anything to do with office right now. You know, they've got all their legacy issues in their existing portfolio. They have a negative bias towards what's going on in the office sector from a supply and demand standpoint. And what the institutions tend to do is at the darkest point in the cycle, they generally take the leasing activity trend line and extrapolate that out. And when you do that, when there's virtually no leasing activity going on, you can convince yourself that it's going to take 10 years or longer to absorb all the vacant space. Now, historically, that never is what happens. Certainly in the tech sectors, our markets are all driven by tech, the markets that we're in, West Coast markets. All the big tech users, whether it's creative tech, whether it's traditional tech, defense tech, life science, go down the list. They're home to all the big companies here. And what you see is that these office markets tend to recover more like a hockey stick.
Right.
So it happens much quicker than most people predict.
So are we at the bottom, though, of that hockey stick yet?
Oh, I think so. And in fact, we're starting to see green shoots of leasing, certainly in the Silicon Valley.
Well, it's interesting to me that you talk about the tech space. This is just one example, but the king of tech at the moment, Jensen Huang, doesn't require people to come into the office. What if the tech world's just changing into a remote work-friendly sector?
Well, I think that it has, candidly.
And isn't that bearish for CRE?
Well, certainly it's created, significant amount of vacancy, right? So I think it's going to typically take longer to absorb that because, you see the tech companies are shrinking their footprints. And it's compounded by the fact that, when interest rates are zero, tech companies are focused on top-line revenue growth.
Right.
And when they're focused on top-line revenue growth, they're focused on growing headcount to generate that revenue. And I think what you saw, certainly during the COVID days, is that the tech companies over-leased space based on forward projections. Interest rates rise, and what you see is then they're focused on bottom-line profit. And I think so, we in the commercial real estate sector were more than happy to accommodate their over projections. Now we're suffering the hangover from that.
Right. So what would be the single biggest driver then of a return to office, given that we are seeing a more remote work-friendly sector?
Well, I think
more broadly?
I think you're seeing a return to office. I think all you got to do is look at the big tech companies and see the mandates. At Amazon, you're required to go back into the office, 4 days a week at least, and you're seeing the same thing at all the big tech companies. So while there are some tech companies that have embraced the work from home environment, there's other ones that are clearly moving back to the more traditional with a little bit of a hybrid piece of the equation. But if you're required to work 3 days a week or 4 days a week, you still need the same amount of office space because people are still coming into the space.
Right. All right, Barry, well, we're going to have to leave it there, but really appreciate you joining us and discussing the CRE space. Thank you so much.
Thank you.
That was Barry DiRaimondo. He is SteelWave's co-founder, chairman, and CEO. Now, coming up here, we're going to have wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for this next hour. You're still looking at gains across the board of the Dow, the S&P, and the Nasdaq. We're going to cover all of the market moves and more for you right here on Yahoo Finance. So stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, trouble in the housing sector. We'll talk about what the latest construction data means for home buyers as mortgage rates, they remain high. And Nvidia is now the most valuable public company in the world. We'll talk to you and with you about how you can play the AI trade with ETFs. Plus, it's a game of value meals. More and more fast food brands are leaning in on lower priced meals to spur demand. We'll talk to one restaurant executive about their efforts to attract customers. All that and much, much more coming up. But first, our top story today, the housing markets here. New data from the U.S. Census Bureau shows construction activity for residential housing tumbled to the lowest level in 4 years. Housing starts in May dropped more than 5% from the previous month, and the slump comes as high mortgage rates weigh on builder confidence. So for more on what this means for prospective home buyers, let's get to Realtor.com Chief Economist Danielle Hale. Great to see you this morning, Danielle. First, you see a print like this come through. What does that signal to you about the housing market right now and where we're trending?
Well, we know that the housing market is in an adjustment phase, especially when we look at the construction sector. Over the past couple of years, we've seen a lot of multifamily construction as single family buyers were kind of navigating higher mortgage rates. And so builders kind of pivoted towards that multifamily sector. And last year, the multifamily sector was really hot. This year, we're seeing that cool off in the multifamily sector as it catches up with that pig in the python, substantial number of multifamily homes that are in the pipeline that are coming to market this year, and rents are softening. So we're seeing a bit more of a pivot back. A lot of the decline in permit and construction activity was driven by the multifamily sector, but single family didn't fare quite as badly. That's good news for prospective home buyers who are often looking to purchase single family homes. We should see that portion of the market remain relatively steady, which should help add some much needed supply to the housing market.
If housing starts continue to fall, what will that do to prices overall?
Yeah, so one of the reasons that we've continued to see home prices increase, in fact, if we look at the median price, it's up over 30% over the past 5 years. On a price per square foot basis, according to Realtor.com, it's up over 50% over the past 5 years. So prices have increased rapidly, and buyers are really feeling that squeeze. In order to get to a point where we're seeing prices get back to a more sustainable pace of growth, we need to see more construction. So what happens in these construction numbers is vitally important. And digging below the surface and kind of looking at the single family versus multifamily breakdown, there's a little more optimism for potential home buyers and the price perspective for single family homes than there is looking at the headline number, which, as you noted, was down, was not a great number. But that single family, multifamily breakdown is also really important.
Where are we continuing to see strength among buying cohorts and then among prospective buyers as well? Where are we seeing some cracks or some outsized weakness?
Yeah, so I talked about that huge price run up that we have right now. So existing homeowners are sitting on a record amount of equity, and that creates this bifurcation. Existing homeowners who have equity have flexibility, but many of them are tied into a low mortgage rate. The typical outstanding mortgage rate for 87% of homeowners is under 6%, and the share of homeowners under 4% is close to 60%. So there's a lot of people with low mortgage rates right now. When you consider the market rate is closer to 7%, they don't have a lot of incentive to move. But buyers who don't have a mortgage rate to consider, so those who already have paid off their home and are looking to buy in cash, investors that are maybe hoping to move money around that don't have a mortgage, or second homeowners who want to get out of the second homeowning business, they can sell and take advantage of those high home prices without worrying about the mortgage on the other side. So they are really in an advantaged position right now. Sellers who don't have to buy, first-time home buyers have strong motivation to get into the housing market with high prices and mortgage rates. That creates high costs, and it is really challenging for those buyers. We still see them wanting to get into the housing market, but they're facing some pretty tough conditions.
And just lastly, while we have you, Danielle, what type of activity would a rate cut finally elicit for the home buying market?
I think when we get to the point where the Fed starts cutting rates, we will see mortgage rates come down. That improves affordability. And I think we will see a lot of those first-time home buyers who have been waiting on the sidelines begin to get back into the housing market.
Thank you so much for joining us here. Danielle Hell, great to see you as always. Thanks so much for taking the time from Realtor.com. And now, to help us break down the latest housing construction numbers by region, we've got Yahoo Finance's very own Danny Romero standing by. Hey, Danny.
Brad, construction activity has pulled back ever since the Fed started raising rates. But there are some regions that new construction for new homes hasn't stopped. In the West, housing starts for both single family and multifamily were 2.6% higher year to date, not seasonally adjusted, according to the latest government data. Now, meanwhile, in May, single family homes under construction in the West were also up nearly 5% from the last year during the same period. A big help here has been California's push for more homes. The state has rolled out new zoning codes to help boost new construction activity. California for years has been trying to really increase housing affordability across the state. Now, despite the robust movement in the West, other regions across the states are losing steam in construction. In the Northeast, both single family and multifamily starts were 22% down year to date, not seasonally adjusted. Now, in the Midwest, it was also down by 8% for both single family and multifamily starts. Now, why are we seeing such a pullback? Well, the high borrowing cost to build has put a lot of construction to the sidelines. And industry experts say that it's unlikely that builders will see a busy season this fall, as rates really remain elevated. Now, if there is a rate cut, that could help boost future construction activity, Brad.
All right, Danny Romero, thank you so much. Continuing to track this side of the economic data, breaking that down for us. Let's turn to a different piece of the economic data that came out today. Turning to the jobs market, new data out today shows the number of people filing new claims for unemployment benefits slipped last week, but the figure did come in slightly above Wall Street estimates. Here with more on the U.S. employment and unemployment side of the equation, we've got Yahoo Finance's Madison Mills. Hey, Maddie.
Hey, Brad. So taking a look at this, the supply and demand picture in the jobs market is not looking favorable for workers. And that is because demand for labor is dropping as the supply for available workers is also increasing. And you can see this in the data here. Jobless claims themselves nearing a 10-month high, continuing claims taking up to 1.82 million. That is a proxy that we look at for the overall unemployment benefits picture. This was in the week ending June 8th, so last week here. The 4-week moving average, which you smartly pointed out earlier today, Brad, this is something you look at because it kind of smooths out any idiosyncratic volatility we might be seeing in that picture. That 4-week moving average rose to 232,750 initial jobless claims. That is the highest it's been since September. Now, I took a look at some of the notes that we are getting out on these numbers, and some are saying that this could be a sign of the school year wrapping up. Some school system employees or those who are, working with children, getting them to and from school, busy with that, they could be using the opportunity of the school year ending to apply for benefits. So it could be seasonal in that way. But when you look just across the overall sector, when you look at, value meals up and up at this value meal price war that we're seeing between McDonald's, Wendy's, you could argue even our very own Starbucks is in the mix there, you start to paint a picture of a world in which we're seeing signs of consumers slow down and struggling. These initial jobless claims coming in a little higher than expected. The latest example of that, and when you combine it with some of the other data that we're seeing, it does appear that we are starting to see a consumer that's struggling. Even if we're not necessarily hearing of consistent layoffs, is the last thing I'll say. That doesn't mean that companies aren't posting jobs more slowly or posting jobs that they're not even hiring for. We've seen a lot of that happening lately, that tech firms in particular will post a job that they don't intend to hire for. So it's definitely getting harder for folks who are looking for work out there right now.
Yeah, it seems like the highest insured unemployment rates in the week ending June 1st were in states New Jersey, California, Washington, Rhode Island, Illinois, Massachusetts. The list goes on, but I mean, you really think about the largest increases as well in this claims figure for the week ending June 8th, California, Minnesota, Pennsylvania. So all of these considered, there is some seasonality that you mentioned. It's a larger question of how the Fed is going to continue to evaluate some of the employment data that we've continued to see them lean on, at least as of right now, for their higher for longer pathway at this juncture.
Well, in California in particular, it's obviously got a lot of stories you can pull from it, but this is supposed to be the big tech capital of our country, and you're still seeing that's a story that we've heard for some time now, seeing unemployment ticking up, and particularly seeing that in the tech sector. What that looks like for employees moving forward who are looking for work in some of these bigger tech firms remains a question, Brad.
Absolutely. Maddie, thanks so much for breaking this down. All things Department of Labor here this morning.
Thank you.
Well, whether you're a novice investor or a seasoned veteran of the market, the ultimate goal remains the same: build your wealth, hold on to it. But there are varying perspectives on how to achieve this. A new study from Bank of America breaks down the generational divide in investing among wealthy Americans with $3 million or more in investable assets. Here to weigh in on the report, we've got Mike Pelzar, who is the head of investments at Bank of America Private Bank. Mike, great to see you, and thanks so much for joining us here, especially on this study and this survey are very significant. You know, first and foremost, what are the kind of asset allocation areas that are being perhaps most trickled into at this juncture? Where are people reallocating into?
Yeah, so Brad, as you say, we do a survey every 2 years of wealthy Americans, and we survey about 1,000 people. What we were looking for this time around was differences in behavior, concerns, investment approaches amongst two different cohorts. What we'll call the older cohort, which was 44 years plus, and then the younger cohort, which is 21 to 43 years of age. And what we found was some stark differences in approaches to investing and mindset toward overall investing. First is with respect to returns. Of that younger cohort, nearly 3/4 of people felt that they could not achieve the above average market returns that they want using strictly stocks and bonds. That's in stark contrast with the older generation who largely felt that you could get there with stocks and bonds. Now, that's somewhat understandable. The younger generation has seen in their investing lives 2 market crashes, right? Think the global financial crisis, the dot-com bust. And then over the course of the last few years, they've seen an increasing correlation between stocks and bonds. And so that's really colored their thinking around how they need to allocate assets in order to generate the returns that they look for. And in fact, if you look at their asset allocation, that older generation has 75% of their portfolios in stocks and bonds and only about 5% in alternatives. But the younger generation actually allocates about 1/3 of their portfolios to alternative investments, crypto and digital assets. So you see a much different profile between those two different cohorts. And I think that indicates lessons learned or things we need to be thinking about in terms of the investment landscape going forward.
You know, it was interesting, and we were just putting that stat up on the screen. The percentage of young investors, 93%, planning to increase their holdings in alternatives in the next couple of years. What are some of the top alts that you see young investors turning to?
Well, this 93% expect to allocate more to alternatives going forward, and that is largely reflective of their views on the growth opportunities in the market. Again, different expectations for the different cohorts. This younger generation sees the greatest opportunities for growth as being in various segments of alternative assets. So think private equity, real estate, even crypto and digital assets. Again, in contrast to the older generation that sees the greatest opportunity in U.S. stocks, international stocks, emerging market equities. Those categories barely even appear on the radar screen for the younger investors. So this interest in allocating more going forward to these alternative types of asset classes is really reflective of their view on these opportunities for growth.
In identifying and really looking across the investment landscape, how has the tenor for, or at least the duration kind of stance shifted, if at all? People who are, and young investors who are looking at where they're going to be able to max out their returns on a shorter duration versus a longer duration.
So clearly this becomes around diversification and taking a long-term view. If you look at some of these alternative asset classes, they're a little bit less liquid. And what that implies is that the younger generation is taking that longer-term view. Importantly, as you think about duration, obviously, rates are high right now. You can get a good return on cash. A lot of investors are saying, I'll get paid to wait by sitting in cash. But we all know that the interest rate environment will evolve over time. So it's important that we don't advise investors to sit in too much cash today. We invest today. We lock in on the fixed income side, some of the longer term rates that we're seeing. And most importantly, we diversify for the long term with their investments.
Just lastly, Mike, while we have you, one of the other things that we're tracking towards is what's been called the Great Wealth Transfer. How is that anticipated to perhaps shift the type of investment vehicles that even the wealthiest people out there are trying to figure out where they can position themselves in?
So we've all seen statistics around the tens of trillions of dollars that are going to pass from one generation to the next over the course of the next couple of decades. One of the interesting findings that we had was that nearly half of wealthy families don't have the most basic elements of estate planning in place. They don't have a will or power of attorney, healthcare proxy. And what that means is that families are woefully underprepared for that wealth transfer that'll be taking place. What we've found is that the most important components of that are communications and engagement within a family, as well as education. When problems arise with wealth transferring from one generation to the next, it's when communications have broken down or have not taken place. People aren't educated on the value of trust and their benefits. And so nobody wants to pass down strife, but roughly 25% of the families we surveyed indicated that they'd experienced some family strife over these wealth transfer issues over time. No generation wants to pass down problems to the next. And so what's important is we have the planning in place and we do the right communication and education up front.
Michael Pelzer, who is the head of investments at Bank of America Private Bank. Michael, great to have you here on the program with us today. Thanks so much.
Pleasure.
Thanks. Coming up, we've got more coverage of the Cannes Lions Festival of Creativity. You are going to be checking out one of our featured interviews, of course, as Yahoo Finance has been speaking to celebrities, business leaders, and everyone in between, mingling in the south of France. Our very own Brian Sazi and Rochelle Cooper sat down with JP Morgan Chase Chief Marketing Officer Carla Hassan. That is next.
All right, joining us now is JP Morgan Chase CMO Carla Hassan. Carla, good to see you. I know you're very, very packed here during Cannes. Thanks for making some time for us.
Oh, it's so nice to be here. I'm so glad to be here with you
So
guys.
Rochelle and I were talking off camera about your role. I imagine right now it must be so exciting because you have markets at a record and now a whole influx of new investors, notably retail. How does that change how you market to this community?
It's a really, really good question, actually. You know, when we think of the wealth spectrum and you've got people that are starting to figure out what they want to do with their wealth. You've got folks that are established from a wealth perspective that know a lot and are very informed. And so for us, it's really trying to figure out how we segment who those customers are and how we talk to them. And so, for example, you know, you've got folks that are starting to think about what their wealth should look like 10 years from now, 20 years from now, 30 years from now. And for those folks, we think about what are the products that they actually are going to need, and for example, like some people like to do it on their own. So we've got a self-directed product for them. Some people like to pick up the phone and call an advisor, right? Because it's comfort for them, right? And so we really think about who are the different audiences, who are the different segments, and then how do we talk to them. Then you've got also a more established client that has, potentially, been thinking about their wealth for a very long time, their future for a long time. And so for them, it's much more about continuing to keep them not just engaged, but feel informed. And so we do a lot of events for them. We bring them to the events. We do some thought leadership. So it really is, you've got to segment it. You can't think about the wealth continuum as just one customer. You've got to think about it as, the different phases of their life.
Are you extra careful in this environment where every day a stock price seems to be going up and you don't want to tell this community, go out and get the stock, or now's a great time? I imagine you have to put certain safeguards in when things are so excited like right now.
I'll tell you, we're extra careful regardless, whether it's an exciting time or whether it's not an exciting time. The thing that I would tell you is, number one is safety of our brand and safety of our customers and our clients. And so for us, it's really about making sure they are as informed as possible so that they have the tools to be able to make the decisions that they need to make for themselves. And so it really is like, we don't, we think about it through the cycle, good, bad, otherwise. We really want to think, we put them first, right? So what are their goals? What are their, there are going to be some clients and some customers that are not as aggressive as others. I mean, I'll tell you, for example, even my own family, right? Between myself and my spouse, we have very different points of view of like how we should actually think about investing our own money. And so you've got to be there for whatever their goals and whatever their targets are, regardless of whether, to your point, it's an exciting time or not.
And it's interesting because we're getting ready for this massive, the biggest transfer of generational wealth that's coming to millennials. How should they be preparing for this? And what sort of tools and resources could put them in a position really to make the most of this?
My gosh, what a great question. And I'll tell you, we think about it all the time. Because like I said, you've got an established crew of people, sometimes older, that understand, that have, good financial acumen, have been thinking about it for a long time. And then you have an entire generation that, frankly, when you think about all the misinformation about financial education that is out there in the marketplace, what we think is what we like to do is make sure that we come in as a trusted brand, right? Helping them, equipping them with thought leadership. So how to think about what's going on, what are the latest trends that are going on in the industry, what are they seeing, what are we seeing in the market, and then informing them so that they can make their own decisions. Because you're right, like today, a lot of them are getting their financial education from social media platforms. And, in some cases that might be totally well informed, but in other cases, we think that there are people that have been doing this for a really long time. We have a brand that is trusted, and we want to give them the tools to help them make the best decisions that they can make for their future. And so it's something we think about quite a bit. And I'll tell you, we are fortunate enough that we have had 200 plus years of doing this, that people trust us. And so we don't take that lightly. We're very, very careful because we understand that, look, thinking about your finances is not easy.
Yes.
And
it's
completely uncomfortable. It's also intimidating. I think there are people that, look around you, even in your own circles and my circles, that are, by any definition, wealthy. but actually don't understand how to manage their money. They're scared to have the discussions with their families about it. And so for us, this generation that's coming up, that's coming into new wealth, is very important for us because we want to make sure we're educating them to make the right decisions. And then it's really important for us to give them the right tools. Like I said earlier, you're going to have some people that say, I don't want to talk to a human. I want to do all the research myself, so have the research ready for me to read, which we do, right? And then have the tools for me to be able to transact as I want to. Then there are others that are like, you know what? No, I need to talk to a human. And we just have to make sure, even by the way, at a younger age, you'd be very, very surprised how many people, even the younger generation that is so digitally savvy, still wants to talk to an advisor.
Well, how concerned are you, Carla, that this generation is listening to experts on YouTube talk about stocks, or viewing people on Reddit as experts, even though they're not? Where are the experts? At companies like a JP Morgan.
Yeah. Look, you're concerned. We're concerned about it. Everyone should be concerned about it. And by the way, it doesn't just sit in financial services. It's across the board, right? How people are consuming information and getting information. And so for us, we think it's a huge opportunity for us as a trusted brand to be able to say, here's years and years and years, right, of getting it right, sometimes getting it wrong, and it's okay when we get it wrong. We say we get it wrong. In fact, sometimes we publish, like, here were our predictions. What did we get right? What did we get wrong? So we can help people understand that. I think the more you do that, the more you show transparency, the more you give people the tools, the more trusted as a brand you are. We just have to be able to be where those consumers are. So we have to also be able to be on YouTube where they are. We have to be able to bring our trusted advisors, our trusted brand to them where they're consuming the information. And I think that's really important for brands today to really think about, particularly as it relates to financial health and financial well-being. You can't just, if you build it, they will come. Even if you are the best brand out there, which we believe we are, you've got to make sure that you go to where they are. And that, I think, makes me have faith when we are where they are so that they can see our information as well. But I'm concerned about it. I'm concerned. I'm concerned for the new generation. I'm concerned for my daughter who's up and coming, right? Like, and thinking about at some point will come into her own wealth, and I want her to have the right information, And so,
Send her to Yahoo Finance. There you go. Quick plug. I
know,
I've
right?
been waiting for the opening. I'm like, let's get her on there.
I get it.
Okay.
She turned 17 this week, so she's ready.
All right, well, Carla San, thank you so much. It was a real pleasure to see you. I know very busy times here at this event. JP Morgan Chase CMO. We'll talk to you soon.
Thank you.
Wall Street is abuzz with Nvidia's rise to most valuable public company. But for all the talk about AI's influence, it's easy to forget that AI technology is really in its infancy at this stage, and investment opportunities are just starting to take shape more broadly. And one way to dip your feet into the AI market could be through AI ETFs. To help explain, we are joined by Sylvia Jablonski, who is the Defiance ETF's CEO and CIO, as part of this week's ETF report brought to you by Invesco QQQ. Sylvia, great to see you. Thanks for joining us in studio.
Thanks for having me.
Okay, so a lot of people trying to figure out what is the best or any ETF way to play AI right now. Where would you point to initially?
Well, I think that AI is arguably the Mag 7 for now, right? Everybody's most familiar with the Microsoft ChatGPT phenomenon and Nvidia and AMD and whatnot. So you can look at a straight semiconductor ETF if you want access to the semiconductor aspect of it, the Nvidias, the AMDs and such. You can also look at, just a straight Qs, large cap tech ETF, because they hold those top, Mag 7, Fab 5, whatever you want to go with names there. You can also look at some niche products that do like a broader spectrum type of thing. So, we, for example, run a quantum ETF where we look at the AI aspect of it, the machine learning aspect of it, the supercomputing aspect of it. So you're not getting only AI, but also the staples and, the conductivity, the communication, the hardware, the software that goes into it. So I would say thematic ETFs, your classic tech trades, or the semiconductor ETF are good places to look outside of single stocks.
Is there a way to almost kind of divide between what is the B2B side of artificial intelligence, who's making the purchases of the Nvidia client base that's buying into the chips, and then on the other side, those players that are creating the applications that consumers are actually touching?
Yeah, and so that's sort of how we look at it when we constructed our ETF, because we think that they're the consumers and the providers of the staples. But to your point, what's tricky about that is every single sector out there is going to be consuming AI, consuming chips, right? So I think that healthcare will benefit from AI. I think that aerospace and defense infrastructure will benefit. Electric vehicles, driverless cars, AI is going to touch just about everything. So I think we're in the infancy stage. And the infancy stage is sort of like, who are the biggest hot names? And that's what people are buying. And then stage 2 is going to be like, what do we need for AI to run? And I think people start looking at things like uranium and copper and energy, right? And then I think that people will look at things like telecommunications, tech connectivity. You look at things like 5G, 6G, right? And then you look at companies like Lilly and all the healthcare companies that have all these drugs, and they're going to start using AI to have more efficient outcomes and generate revenues through the use of AI. So it's going to touch everything.
To what extent are investors identifying or at least evaluating right now where cybersecurity as an investment strategy also has that AI annexation? Because that is one of the core concerns by users, whether it be some of the businesses that are trying to build out data centers that are leveraging these chips that have inferential technology abilities, and then the core users, the customers like you and me, that are just saying, I just know that it gets to me and that I'm able to tap into it, open up an app, and it's going to, based on what I prompt, return something that is saving me time.
Yeah, and actually, so you just gave me 2 new ideas for ETFs to look at.
I love to do that. I love doing that.
You have to look at the cloud ETFs, and you have to look at the cybersecurity ETFs. And so that's a great point. The idea there is that we're going to have all of this data, right? And this data somehow needs to be protected, and it needs to be housed. So cloud for the housing, that's your Amazons, your Microsofts, and then you have your, the cybersecurity side with the Palo Altos and some of these other types of companies. So 2 other great spots to look at, and absolutely, that's going to be a massive theme, especially when you think about some of the concerns we have right now with like TikTok and trade relations with some of our Asian counterparts, and the role that cybersecurity is going to have to play there. Throw AI into the mix, and that's another massive compounded annual growth opportunity, in my opinion.
Sounds like I might make it into my first ETF white paper. I'm not sure. I'm just throwing it out there.
You're just about there.
Sylvia Jablonski, Defiance ETF CEO and CIO. Great to see you. Thanks so much for joining us.
Thanks for having me.
Absolutely. Everyone, coming up, value menus coming back to fast food chains in an effort to lure back some customers. We've got Subway's North America president here to discuss. That's next. As high prices continue to affect consumer spending, fast food restaurants have been taking a hit, especially as low-income consumers, they're dining out less often. So in an effort to make sure that we can lure back customers, chains like McDonald's, Wendy's, Starbucks, and Subway adding value deals onto their menu. Here to discuss Subway's latest efforts, we've got Doug Fry, who is the Subway North America president. Doug, great to have you here in studio with us today.
Thanks, Brad. Really excited to be here.
I mean, what are you sensing in the environment right now among consumers, where they're pushing back on certain menu items and where they're relying on some of the quick service restaurants to hear what their needs are as well in the menu right now?
Yeah, I think if you look at the food service industry today, we as consumers see it everywhere, that suddenly these items are popping up on menu that are offering greater value. The challenge I have with that is that sometimes greater value comes with a sacrifice, and that sacrifice is often, a sacrifice on quality to get to price. And we at Subway don't believe that our guests should have to sacrifice quality for price, and that's why we are offering sort of a wide variety of menu items that fit everyone's budget and everyone's appetite as well. And as you know, when I look at, and it's not just about price, when I look at value, I really look at price, quality, and quantity. And that wraps up into something that you also want to feel good about eating. And consumers are looking for snacking on the go. Consumers are looking for something that's a great price point that still has the flavor, still has the taste to it. And earlier this year, we've launched our footlong dipper, or our footlong sidekicks, our footlong pretzel, our footlong churro, our footlong cookie, and now this week we're launching our footlong dippers, which are $3. With 11 different sauces to choose from. And it's once again offering value, great taste, great product, without sacrificing quality.
What are the responses that you hear from franchisees as well? I mean, that are putting up their money to make sure that they can grow their wealth through an investment and because of a nationally known brand like Subway?
So what are franchisees?
Yeah, what's the response that you're hearing from them as well with regard to some of the new promotions that are being able to be put into market also?
Yeah, well, these $3 dippers are a great example where we collaborate and work with our franchisees to listen to our guests more, to understand what our guests are looking for, and our guests are telling us they're looking for snacking on the go. And so instead of sort of reorganizing a menu, we're coming out with new menu innovation to really speak to those guests, to bring in new guests into the restaurant that are going to be really attracted by a $3 footlong dipper that they can take and run with. And that's the type of work we do with our franchisees to really find that balance so that we meet the needs of our guests, exceed their expectations, but also meet the needs of our franchisees from a profitability perspective.
When we think about, and this is something that you mentioned a moment ago, and I think it was so correct in that when you see some value offerings that are put out there, they're put out there with kind of the sacrifice on quality. And some of that sacrifice on quality has been in the food system, especially in the US, compared to other areas around the world as well. Are we making a significant or sustainable turn in that, where there isn't as much of that sacrifice on quality when there are new menu items that are put into market as well?
Well, I can certainly speak for Subway. I mean, when I think about quality, I'm thinking about freshly sliced meats, fresh veggies, freshly baked bread, all wrapped up into something that you can feel good about eating and also good about spending your money on. Yeah. And that's what quality means to me, and it comes back to that earlier point around what value means as well. It's about quality, quantity, and price. And so as we look at new menu items, it is about trying to contain that, or continue along that line of offering something for everyone.
When you think about the consumer right now too, I mean, there's the wave of the GLP-1s, the weight loss drugs that are impacting appetites. To what extent are you seeing that flow through to which menu items are being purchased and at a certain cadence when people are engaging with Subway even right now?
Yeah, when our guests engage with Subway, they're engaging. I look at some of our super fans who are part of our loyalty program, our MVP rewards, and those are also the folks that are putting us out on TikTok or putting us on Instagram, and they're talking about snacking. They're talking about great products that taste great, that have good flavor, that they can grab and go. They're also talking about our 6-inch subs. They're also talking about the footlongs, and certainly the sidekicks, because they've been a massive hit as we launched them in January. And I'd say that's where folks are talking. They're talking about our food, they're talking about the quality of our food, and they're talking about the value of it for the price.
How does this impact prices long term? I mean, if consumers become really annexed to some of these value deals, what does that mean for the normalization of prices on a go-forward basis too?
Yeah, I look at what we offer, and we've got everyday pricing. We've got promotions. We have loyalty, and I think as you look at the food service industry, let's talk about loyalty for a second here. I think loyalty is a really important aspect of this industry. And for Subway, ours is called MVP Rewards. We relaunched it about 9 months ago. And it really is about, our super fans would tell you that's the place to get the best deals, the best perks. They get, free Chip Fridays, they get birthday gifts, and they get cash back. In fact, in that 9 months since we've launched, it's about, I think, it's about $60 million or more in cash back to those super fans, those loyal users through loyalty. And I think that's where consumers are starting to really look is, how do I get, the bigger bang for my buck, and how do I, really get the value out of that? And that's certainly loyalty programs are where you're going to start to see, I think, folks, take more advantage of that as a consumer. I know I certainly do.
Yeah, same here. Doug Fry, Subway North America President. Thanks so much for taking the time here with us.
Thank you, appreciate it.
Absolutely. Everyone, we've got much more on wealth coming up after the break. You're watching Yahoo Finance. The goal of any investor is to make the most money possible in order to build wealth. But it doesn't just start with the stock market. How much money you have depends on a number of factors, including career earnings and access to capital, which has historically been disparate across ethnicities. For example, the Department of Labor says a Black American worker earns an average of 76 cents compared to a white American worker's dollar. But we have to back up even further because it's not just about how much money people make, it can also be about how much money you were born into. For instance, a typical Black family has 15 cents in wealth for every dollar held by a typical white family. And our next guests talk about this in their new book. Joining me here in studio, we've got Louis Story and Ebony Reed, co-authors of the new book, 15 Cents on the Dollar. Great to have both of you here in studio with us, and thanks so much for taking the time.
Thank you.
Thank you. Absolutely. You know, I was reading off of some of those stats earlier on, and our team was discussing this, trying to figure out exactly where to start because there's so much to cover here in so much little time. But Ebony, I wonder, as we're thinking about where there is a shift in trying to close this gap, what you're finding from individuals and their relationship, even in their earnings as well, and being able to put that to work for themselves.
Sure. So in our conversations with the hundreds of people that we interviewed for this book, we did see a difference generationally between millennials and their parents in terms of how they think about building wealth and whether or not home ownership versus stock investment is really the best direction for this current generation.
Absolutely. And who's this driven by largely? I mean, if we're pointing back to one thing, Luis, where does this really stem from in terms of the largest gaps that are still remaining persistent at this juncture?
Well, one of the biggest factors is simply inheritance. You know, after the Civil War, we have this long-running data in the book, but the average Black family had 1.8 cents compared to $1 in wealth in the average white family. So it's gone up. We're up to 15 cents. But, you know, actually 15 cents is where it was in the 1950s. It's moved around. It went up. It came down. And so a lot of it is just passing through generations when people die. And also, you know, throughout your 20s, 30s, if your family has money, they would be potentially giving you money, helping you with things. And so that's a very big factor in it.
Absolutely. I mean, when we think about where this is also going to be in terms of the generational wealth and the great wealth transfer that we've also been discussing here too, that could change how people invest, that could change the types of jobs that people want to go into. What are some of the most significant shifts, especially when you layer on ethnicity on top of that we could potentially see in the future as well, Ebony?
Well, one of the biggest issues right now facing Black Americans is student loans. And as there has been, you know, an opening and access to college, it has also come with costs. So in our book, we have several people that are impacted by, you know, student loan debt. I mean, one family, for example, the son had $100,000 in student loan debt, and so did the mother.
Wow. And so this changes savings and how much you are having to put from your earnings back towards just paying off debt too, and changing the occupations that people might step into as well.
That's right. And, you know, it really confuses people because, you know, when we talk to people and we say, the Black-white wealth gap, it's 15 cents on the dollar, people say, but wait a minute, the person sitting next to me at work, I think they make about the same amount and they're a different race, so why can't they save like I do? But they may not realize that that person may have more student loans, for example. So debt is hidden, but debt really holds people back from building wealth. And debt is not necessarily something somebody did that was wrong. Sometimes debt was taken on to advance their careers and advance their lives.
Right. What are some of the biggest ways that we've seen in recent years, perhaps, to help eliminate some of that debt as well? I mean, people like myself who are still trying to pay off some of their student loans are just thinking, okay, maybe I need to tap into a government assistance program, or maybe there are grants that I can apply for as well. Are those being advanced and elevated and tapped into?
Well, you know, the biggest thing is President Biden has caused a lot of debt forgiveness, in particular restructuring the interest payments. And so even though the Supreme Court did not uphold his student loan program, I mean, it is over $100 billion that's been affected in student debt, and in particular on the interest payments, and also for people who had more debt now than they had when they graduated, which skews towards a non-white group. So that is a big decrease. But I'll add a different thing. You know, wealth and debt, these are topics that most employers don't think about. Most employers focused on these issues are thinking about pay and pay equity.
Right.
So this is maybe an opportunity for companies when they want to think about the well-being and equality among their employees to think about the wealth calculation and where they can help their employees also on the debt side.
That's a great point. Just lastly, while we have you, one of the other major things for new business entrepreneurs out there, people who are starting their own small businesses and maybe hope to get them up to large enterprises one day, it comes back to the access to capital, which has historically, of course, even if we were to look back and chart who was having access to capital and who was perhaps being turned down by some of the banks out there, that has had more of an impact on a lot of Black Americans, a lot of Black Indigenous people of color who were trying to have access to that capital. Is that shifting from what we're seeing, especially coming off of a wave of commitments that had taken place back in 2020, 2021?
Right. So we have seen some recent challenges and pushback on DEI programs. I think one thing, that I certainly wonder, as a Black woman, is people who are challenging that. If having diverse ownership is important, then what are the alternative plans? And so I think those are good questions to ask people who challenge those programs.
And additionally, challenging founders funds as well. The Fearless Fund, one of those instances that we just saw get challenged. I mean, if that is the case, how can funds who are trying to make sure that they're elevating entrepreneurs, ethnicities that have been blocked out from capital, how can they make sure that they're still able to advance that initiative without the scrutiny from a court perhaps blocking what they're trying to do and get at?
We agree, and we think a big part of the problem is people don't know this data. They don't know that it's less than 1% of founders, VC-funded founders that are Black. They don't know that the Black-white wealth gap is 15 cents on the dollar. So first of all, we've got to make people aware that this is the gap, and then once they know the gap, you can say, well, does that bother you? And if it does bother you, which many people will say yes, I'd like things to be more equal, then you say, well, then what do you propose to do about it? So we're starting with the awareness in our book and trying to build from there, because there's actually a significant gap in awareness around these numbers.
Absolutely. Let's toss the book cover up on the screen just so the good folks at home and viewing, wherever they may be on their mobile devices or wherever Yahoo Finance screen is available. There is the cover, 15 cents on the dollar. Louise Story and Ebony Reed joining us here in studio. Thanks so much for the time.
Thank you.
Absolutely.
Thank you.
That's it for Wealth today, everyone. I'm Brad Smith. Thanks so much for watching. But guess what? There's more Yahoo Finance. Stay tuned. Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to the closing bell. You don't want to miss it. I promise.